We are seeing clear signs of a demand slowdown.
We are slowing, there's no doubt about that, but the recession debate continues to go on.
I have a surprisingly positive outlook.
When you introduce this level of uncertainty, it's hard not to see, auction price levels as quite compelling.
We find that the value of diversification has certainly gone up quite tremendously.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television, Tuesday, in a complete, full, quarter-ending, first-half-ending week. We're going to go to Maria today in a moment on all going on in Russia, in Belarus, in Ukraine. But I got to look, Lisa, finally today, a wall of economic data to try to figure out exactly where are we. Brief me.
Yeah.
Where are we?
Well,
Help me.
We don't know where we are. That's part of the problem. We're getting a host of data, including a host of housing data, and I'll get through it here in just a minute. The key question for me is, are we on the downward shift, or are we reverting to some sort of upward trajectory, particularly with the housing market, where we are seeing signs of a rebound? Is there enough softness in a consistent manner across all sectors to give central bankers a sense of ease? Well, that's not the tone we're hearing over in Sintra.
And in Sintra, this is in Portugal. Think Jackson Hole without the Cowboys. Francine Lacroix with Gita Gopinath coming up. I know you're going to talk about that as well. And we're going to start here in a moment with Maria Tadeo. What are you watching with Mr. Putin?
I'm watching to understand who is supporting him, what the relationship with Prigozhin is. He's saying now he is going to honor his word in terms of granting him an amnesty, except that the Wagner troops are being disbanded. It's not a complete chapter yet. There are a lot of questions that remain, including where are the oligarchs, where are the military leaders, who is supporting Vladimir Putin, and what does this mean longer term about his tenure atop one of the big nuclear powers of the world?
We'll give an update on that in a moment with Maria Tadeo in Brussels. Let me get to the data. It's important to get to Maria. And then Jack Ablin to start us off strong across surveillance today. Futures up 8, Dow futures up 10, the VIX 14.26 really shows a stability over the last 48 hours, even with all in international relations. 10-year yield 3.73%. I got nothing to talk about here. Oil, $68.49. Maybe oil's a little soggy, $68.51 on West Texas. Brent crude under $74 a barrel, and I'm going down in flames here. The currencies just 109.44, and the euro, renminbi, not even renminbi's giving me something to talk about, 7.22.
I'll give you something to talk about.
Please.
In particular, the euro strength is interesting to me and bumping up against 110 after the comments we heard from Christine Lagarde at that Sintra conference this morning, where she said that they are going to hike again in July and their fight is not over, even after disappointing data that they got with respect to the PMIs out of the euro region. It is day 2 at the ECB forum in Sintra, and I'm looking at the 210 spread in Germany, which is now the most inverted going back to 1992. At a time when people are forecasting the ECB to raise rates, and then that leading to slower growth.
I'm so glad you brought this up, because when we say 1992, folks, in America, that's not like 1992 East Germany, West Germany, and the reunification. So I think there's a real inversion there. It's got a real historic feel to it versus the usual analysis in America.
We're also looking, as you said, about eco data in the United States in particular. Home price data coming out at 9 a.m. We get S&P CoreLogic and FHFA housing data. We have seen a massive rollover of some of the data, in particular the S&P data. Does this give a sense that we're actually seeing the heat come out of this market?
Keep this chart up here on radio. It's real simple. Housing inflation and a massive plunge. This is the 20-city Carl Case Robert Schiller Index. And what's, the detriment here, Lisa, is old news. It's 2 months, 3 months old. It's not current housing data. But I think it's got enough import and enough trend to it where I really lean forward and watch it.
Especially because it is the lagging data that goes into CPI, which is factoring into the Fed's decisions. And today we do get some earnings. Walgreens Boots Alliance at 7 a.m. will be covering that. Those shares have been beaten up so far. Manchester United is also having their annual general meeting to talk about maybe Middle Eastern money. But I do want to say this earnings season will be unlike any other, particularly with the tech giants. And so any read that we get in, we could see disappointments are severely punished. do we have some sort of tipping point in markets if you don't get some sort of blowout results?
That's, I'm glad you bring this up because that's the tension right now. We've got all this distraction of Russia, but the bottom line is this massive mystery starting, I believe, the 14th of the month with JP Morgan. And it's going to really be, folks, we're going to really try. Lisa's taken off all of July, but other than that.
Pretty much.
Okay, there's our moment of silence for my vacation plans. Futures up 8, Dow futures up 17. She did a killer job over the last 48 hours from Brussels, coalescing all of this news on Russia. Maria Tadeo joins us now from Brussels. Maria, it seems like we're focused on Belarus. Slice through the noise. What is the lesson or the observation from Mr. Lukashenko this morning?
Tom, the key question for me is, what did Lukashenko get out of this? What was he promised by Vladimir Putin? Because these two, they act like they're friends, they're allies, but we know that this is a very transactional relationship. Vladimir Putin has now essentially sent away Prigozhin, a headache away from Russia. Belarus is going to host him. Today, Lukashenko said he will honor part of his deal. But again, the question is, what's in this deal for Lukashenko and Belarus? The other key point to me is Wagner, the future of Wagner. I think it's safe to say today, I'm not sure if it's the end of Wagner entirely, but it really is the end of Wagner as we knew.
Last night, we heard from Vladimir Putin coming out, giving his first address. Since a lot of this news went down, a lot of people were surprised it didn't say more. What are some of the questions that people are asking about why Vladimir Putin did grant amnesty after all of that to Prigozhin and also is trying to move forward? Is his leadership truly threatened, or is it basically behind them?
Yeah, and that speech from Vladimir Putin, if I may say, yesterday was pretty boring. In fact, there was a lot of thank you, spasiba to the people of Russia for their patriotism. Again, we should note, we don't really know what the people of Russia think, because at this point you have legislation that if you say anything against the war could get you in jail. So it's very difficult to tell. On the one hand, again, repeating that they have crushed this rebellion that Ukraine is led by Nazis. When it comes to Prigozhin, however, it's very unclear because yesterday, Vladimir Putin said the leaders will be brought to justice. This morning, the Russian MOD says that probe is closed. The key point, however, is that we have not seen pictures nor footage of Prigozhin. We still don't know where this man is or his condition.
Maria, we're going to join you in the next hour with Anne-Marie Horton to give us the transatlantic perspective. But right now, if all of this didn't happen, does Mr. Putin still have control of the military as he did, say, 5 days ago?
It seems to some extent that that's what he wants. And the key point when it comes to Wagner today is that they have now decided or agreed, according to the Russian MOD, to hand over their weapons. Vladimir Putin also yesterday said either you join the Russian army or you go to Belarus or just go home. And then yesterday, Shoigu, the defense minister, was back in the picture. So the optics around this is that this is now the Russian army who's going to deal with the operation in Ukraine, not Wagner. The problem for Vladimir Putin is that objectively, Wagner has operated better than the Russian army in Ukraine.
Maria Tadeo, thank you so much. We'll see you in 60 minutes. She is in Brussels, spearheading all of our coverage here on Mr. Putin and the debris of the last few days. The debris of the market is you're not in it. Jack Ablin is the kind of person that gives you confidence to be in the market, Chief Investment Officer at Crescent Capital. Jack, I love your note, which goes to the heart of my thesis for 2023, which is corporations will adjust to the cards they're dealt. You talk about a new corporation, a new constituency. Are corporations adjusting to 2023 and a potential recession?
I believe they are. I think that they're certainly not holding the cards that they once were. During the globalization move that we've had from, call it 1980 through 2012. What we are finding is that their clout in Congress is not as strong as they had in the past. We're seeing that, of course, with Microsoft, Activision, and some other challenges that that a lot of these mega cap tech companies are facing right now. So, yeah, I don't think they're holding the cards that they have, and they have to make an adjustment.
Jack, the resilience in the market right now is shocking to me. We've gotten so much news, whether it's Russia and the uncertainty there, whether it's the ECB and the decidedly hawkish tone out of Sintra. What do you sort of attribute this incredible resilience to? The fact that a lot of stocks are shrugging off all of the walls of worry and saying, you know what, we're going to do just fine.
Yeah, I mean, I think that many investors are looking past the turmoil, perhaps, and focusing instead on mega cap tech as their savior. Here, I think that's run obviously a little too far. We have projected the S&P to be up between 5 and 7% this year. We're up, nearly 14. So I think that there will be some sort of a reversal, particularly when you look at the spread between S&P cap weight and S&P equal weight. I think equal weight is up around 3% or something like that this year, which is really more in line with our forecast. So we think that we could get an index pullback, but a broadening of breadth.
And we've seen a lot of people reiterate this type of sentiment recently. A number of banks have come out and downgraded some of the big tech names, not because they think that they've got bad prospects, but simply because valuations have gotten over their skis. What's the catalyst at a time when even the idea of a hawkish central bank isn't killing these stocks?
Yeah, I think that, right now, Chairman Powell is certainly flapping his arms for 2 more rate hikes. I call that the federal open mouth policy. Perhaps he won't have to execute on that plan. I think that 5.25 is enough. I don't think we need to go much farther than that because fact is that if you look at PPI, which tends to lead CPI, I think we're up 2.8 year over year. So I think we're in a nice downward trajectory in inflation. I think it will cool off on its own. Right. Keep in mind the lag effect. And, once ECB, BOE, take the lead, I think those currencies will move back to fair value. They're all undervalued. I mean, the yen is remarkably cheap relative to the dollar. So I think that's a catalyst for international developed.
Jack Ablin, I want you to push against the outrageous bear, Douglas Cass, because I'm hearing some optimism here. Cass he's grim. He's like a grim bear. Forget about it. I'm hearing optimism from Jack Ablin. How do we establish a second leg to a bull market that Ralph Ankapour and Ed Yardeni called in October?
Yeah, I think it's the handoff. I think it's a handoff away from the mega cap techs and a broadening of the U.S. large caps into the average name. But it's also a handoff from U.S. centric to international. Just look at the currencies. Euro, probably 15 to 20% cheap relative to the dollar. Yen, probably 40% cheap relative to the dollar. And so you really have a couple of catalysts. You've got not only valuations trading at roughly half that of U.S. large caps, but you've got currencies that are remarkably cheap on a purchasing power parity basis. So essentially, from our perspective, you have 2 ways to win in a trade like that. I think Doug's a great guy. He's a very smart guy. When he goes bullish, I'll listen.
Jack Ablin, we'll leave it there with all that's been going on. Lisa, forget about bull and bear. Jack Ablin alive, Doug Cass dead, with the Dead and Company and all that out there. But this is the debate right now. You've encapsulated this perfectly in that we're on mid-year reviews and outlooks, and the disparity is just as stark as can be. You have on one side the Mike Wilsons of the world, and Goldman Sachs seems to be joining them as well, basically saying that valuations are capped by where rates are and the fact that things have gone up so quickly. And then you have other people saying, this is a game changer. You have artificial intelligence, the whole trend there and the spending. You also have a better than expected economy. Why can't you look at the fact unemployment rates are low and celebrate? Yeah, and I look at it constant at Goldman Sachs, and I think they were constructing a bullish scenario a couple of weeks ago based on multiple expansion, and that's maybe drifted away. We'll have to dig into that across all of surveillance today. Coming up, our Francine Lequan, Portugal, at Sintra, a conversation with Gita Gopinath of the International Monetary Fund. Stay with us on radio and television, Bloomberg Surveillance.
If Putin is out, the person or the regime that may replace him, actually, we may need to have a much more strong response to that kind of regime that may be much more hawkish, much more hardline than Putin himself.
I will not mince words. Saturday night in the chaos, a select group of voices on Twitter cut through like a knife. One of them was Ian Bremmer from yesterday. We're going to talk to Julie Norman here in a moment. She was wonderful. Leading was Alina Polikova, President and Chief Executive Officer of the Center for European Policy and Analysis. Alina was just superb in the uproar Saturday, I believe it was Saturday evening.
And the background to this is that the uncertainties and the rumors just absolutely abounded, the catastrophic scenarios, the potential Goldilocks scenarios, everyone coming out. And here we are 2 days later. What have we learned? Do we have more clarity right now?
I strongly agree that we don't have much clarity right now. And I think that's what we're all struggling for. And that's why we've got Maria Tadeo reporting from Brussels, Anne-Marie Horton in Washington as well. Right now, with futures up 7, we're going to go to someone with a measured voice on these affairs. Julie Norman has assisted us. Her first work in academics was in terrorism worldwide, but she's expanded far beyond that with a remit at the UCL Center on U.S. politics. Julie, how should the West respond to Vladimir Putin?
Well, Tom, I think in terms of what's happened this weekend, Biden, NATO, and the West in general have been playing this right so far, in that Biden very quickly on Saturday immediately made contact with Moscow and said, this is an internal affair. We're not having anything to do with this. This isn't an outside job. And they've been publicizing that communication since. That's been trying to get ahead of very likely conspiracy theories within Russia, from Putin himself, about all this being orchestrated from the West. So I think they were right to have that communication, but also to mostly stay quiet while this is playing out and let this be the internal affair that essentially is, while obviously continuing to support Ukraine as they have been.
Do you think that we will get a different theme from the dictator of Russia, and that he will talk in some changed way about the Nazification and all these other inflammatory words we've heard from Vladimir Putin? Are we going to get a new script in 2023?
Well, Tom, I think one thing we know about Putin is he's unpredictable. It's been very hard to read his movements, his narratives throughout this whole war and even before that. The way he responds to this, as we've just been talking about, is still unclear. My sense is, if anything, we can probably expect more of a doubling down on some of the terminology and some of the rhetoric and some of the policies he's been engaging in before. But again, his responses to everything that happened over the weekend was a bit different from his usual playbook. So we really don't know how he's going to move forward from this and what tactics he's going to use. But I do expect him to keep moving forward, and I don't see him stepping aside or something like that just because of what transpired over Saturday.
Julie, do you have any sense of what Lukashenko is getting for Belarus to be part of these negotiations and housing potentially Wagner troops that have been disbanded?
Yeah, it's a great question, because that's been a bit of an unknown throughout all this, what Lukashenko's role was in mediating, if he offered that, if he was asked to step in. I would note this comes just a week after Putin, and we've been confirmed elsewhere, has started moving tactical nukes into Belarus. So Belarus, one way or another, seems to be emerging as an even stronger player than it already was in all of this. And a lot of speculation on to what that means. But I imagine there will be a lot of attention on him and on Belarus more broadly as the counteroffensive continues and as this war continues.
I have to say, I was reading part of the readout from the meeting in Belarus between Lukashenko and Prigozhin and the Russian counterparts, and a spokesperson saying that they were very difficult conversations. They immediately blurted out such vulgar things it would make any mother cry. The conversation was hard, and as I was told, masculine. This is sort of the readout that everyone can imagine. That is actually what it said. But from your vantage point, Julie, what are you asking going forward to indicate how much power Putin still has, whether he still has the consensus of the oligarchs, whether he still has the consensus of the military?
Yeah, so I think there's a couple different moving pieces here. There's Wagner, the Wagner Group's own trajectory moving forward, which I think will be much scaled down. There's Putin's trajectory moving forward, which I think many are saying is very much on its downward spiral. I would say it's a little premature to say that. I don't think this is going to be, a death knell kind of thing for Putin. I do think we'll see him rebound from this. And then the other question is what this will mean for the war right now. Is this going to decrease morale to a certain degree for Russian troops that'll change the dynamic for the Ukrainian counteroffensive or not? So there's a number of moving things that I would just say, if I'm being honest, we just don't know enough right now about how most of this will transpire from here.
So what do you think the next couple of days will bring? I mean, I love the idea, Professor Norman, that we don't know where we are. I think we all feel that. What's the Norman bet for the next 72 hours?
Yeah, the next 72 hours, I would say, I think we'll see Putin trying to regain and restabilize his authority. We've started to see that even over the last 24 hours with some of the speech and the statements that he's made. I expect that we will see some of this play out on the battlefield as he tries to, again, assert his control of the situation. So I'm looking at most of where this is going to play out in terms of the war, in terms of the battlefield, as well as, of course, what's happening inside the Kremlin.
Julie Norman, thank you so much for joining us today from the University College London Center on U.S. Politics as well. She really crystallized for me the uncertainties there, and I guess they're different uncertainties, but they're the same uncertainties as this weekend. Nothing's changed.
Nothing's changed, which is remarkable given the fact that so many questions abounded. What I find fascinating is in markets, the response is still pretty much nothing, right? If you can't game out a scenario, just ignore it because there's so many uncertainties. And that's what we heard from guests yesterday. There's so many uncertainties. So why should I plan for one that's, either way could be extreme on one end or the other? Dollar ruble, which Damian Sassower tells me is not a real market, migrating here out to 15-month weakness here and buttressed right up on an 84 up to 85 level, 84.90. I don't have any wisdom even on a weekly chart. You can do that on the Bloomberg terminal, folks, GPW space roll. I mean, the other than the spike of the war, the shock of late February when we were speaking to David Folkets-Landau about this, the ruble's out to new weakness other than that spike. If you want to, we're above the long-term moving average here on ruble weakness. I did not know that. I mean, there's some real fragility there. That's one indication, although, as Damian Sassower says, the ruble isn't a real market. Not that many people trade it, and it is sanctioned even. That limits even further trading in that currency. I'm looking at the commodity sector, seeing oil prices lower, even as potential disruptions abound. Copper prices lower, even though, again, you could get some sort of disruption in supply chains. So these are the kinds of things that we're not seeing any kind of major reactions, even though there still are so many questions remaining about one of the world's biggest nuclear superpowers. A pandemic boom in commodities, just to use the index levels, folks, from 60 to 130, called a doubling in price. I remember Newcastle coal. I thought Newcastle coal was in England. And I got an email from a guy from Perth who said, no, Newcastle is, I can't pronounce it the way the Australians pronounce it. You thought that Newcastle was like a club team? It's sort of north of where the Veronicas live is all I came up with. Anyways, there was a commodity boom here from 60 to 130, and we've given up, a quarter of it. We've given up a third of it. But I totally take your point. And this goes to Gita Gopinath coming up here with Francine Lacroix. The arch issue here is the IMF call that we witnessed in Washington for global slowdown, with Dr. Copper as the global thermometer. And the global thermometer of Dr. Copper is indicating downward this disinflation that central bankers are counting on, which Jack Ablin mentioned. And Carl Weinberg yesterday, the most positive he's been since the 1960s, because he thinks that the central banks are going to get back to their goal within the next year. And you heard it from David Folkets-Landau off our London desk at Queen Victoria Street as well. Some of these grizzled guys that have been through this a fair amount, they're not doing what we're doing, the punditry and all that. They're really thinking about what's the outcome 18 months out, 2 years out. And they're pushing against Bramo here. I mean, they've got some serious optimism going. This is sort of one of the tensions that I find fascinating. Bonds pricing in the now, which looks potentially fraught. Stocks saying, forget about it now. It's going to be fine. Forget about it. So which do you go with? We'll see. Coming up, with the International Monetary Fund, the first Deputy Managing Director, Gita Gopinath, in conversation with the Pulse's Francine Lacroix. Gita Gopinath, we do that next.
Bloomberg surveillance from New York. Lisa Abramowicz and Tom Keene, Jonathan Ferro on assignment. And we look here at the end of June and into July. We're focused on mid-year outlooks, but we're also focused very much on the path forward for our global economics. Futures up 8. They noodle here. I mean, Francine, what's a single? Lisa, what's a single thing you see on the data screen today? I had renminbi to help me out yesterday. I got nothing going today.
Well, to me, the euro is interesting because of some of the hawkish comments out of Sintra. The fact that ECB's officials have been talking about continuing to hike rates, and you are seeing that euro bump up versus the 110 versus the dollar kind of measure. The yield curve, especially in Europe, fascinating, the most inverted going back to 1992. A
little less inversion in the United States, 96 basis points off 103 basis points. And critically, I haven't mentioned this yet, this morning, the 10-year real yield in the United States had a bit of a rebound in the last 24 hours back to that 1.54% level. It is without question the hallmark research analysis of the year. You could hear the silence in Washington as the International Monetary Fund, led by the economics of Gita Gopinath, looked out to 2028 and saw a growth trajectory that took us back decades to 1990. It was an extraordinary call on tepid economic growth. We need an update. We go to Portugal and Sintra, the meetings of the European Central Bank. Francine Lacroix of The Pulse in conversation with Dr. Gopinath. Francine, good morning.
Good morning, Tom. I am delighted to be joined by Gita Gopinath, of course, of the IMF, who yesterday also really opened the forum here in Sintram with a very powerful speech linking fiscal policy and monetary policy and really reminding everyone that they had to work in tandem. So, Gita, thank you so much for joining us. When you look at the fight against inflation, there's now a lot of talk about recession, the fact that core inflation is still high, but headline inflation is coming down. What does a policy mistake from central banks now look like?
First of all, it's a pleasure to join you, Francine. What you're experiencing is that inflation is taking a long time to get back to its target. And yes, headline is coming down significantly, but core inflation, while it has eased, is still persistently high. So in this environment, our advice is that central banks will need to stay the course. In the case of the ECB, that will mean that some more continued tightening, and then to stay on hold to make sure that you're confident that inflation is coming back durably down. And that could come along with more weakness in labor markets that we've seen so far and more weakness in the economy in general. But that's what is needed to bring inflation down.
Do you worry about the markets? And I know you don't look at the markets day in, day out, but there seems to be a bias in the markets that actually inflation is coming down and that central banks will be ready to not hike as much as maybe they will. So is there a danger that the market is mispricing something that will then create an event?
Well, the markets have been off since the start of this year. I mean, if you look at their expectations of the policy rate path in some countries, especially the US, they were expecting 3 rate cuts this year for US Fed policy, and they have adjusted. They've come back now to recognizing that no, we are here for longer than was expected. So I think markets have been very optimistic, and I suspect they're still somewhat optimistic about the path for interest rates.
What do they most misunderstand? Is it the fact that interest rates have to remain higher for longer, which Christine Lagarde actually laid out beautifully in her speech, or that they have to rise higher than expected?
I think it's how long they're going to stay at that. I think that's the part where there is a disconnect between the markets and what central banks are signaling. And so far, it's the markets that have had to correct to central bank paths as opposed to other way around. So I still think that they're off a bit on the duration for which they'll have to keep rates high.
What's the path forward for growth? Should we worry about once we get inflation in control?
We are seeing growth weakening. We are seeing slowing activity at this point. We need to bring inflation down to have sustainable growth, which is why it's super important to do this. This time around, since it's not just a demand phenomenon, we've had supply disruptions correct themselves. We've had energy prices come down. I think both those factors are helping bring inflation down without needing too much of a hit to the economy. But I think we have to wait and see. We're only just seeing the effects of monetary policy work through the system now, and we could see much more slowing.
But is that why, I mean, why is core inflation so stubbornly high? No one can quite figure it out, which is why it keeps on surprising us to the upside.
It's a big part of the conversation we're having at Sintra, which is it the fact that monetary policy transmission is now weaker than it used to be, or is it the fact that you haven't raised interest rates by enough? I think these are questions that are coming up. We have a situation where it has been the case that household balance sheets, corporate balance sheets have been strong, which has helped hold up resilience. Labor markets are tight. People believe that they will have a job, and they can keep a job. Wages are going up. And services spending tends to be much less interest sensitive than when it comes to durable goods, which consumers piled up on already during the peak of the pandemic. So I think all these factors could be muting the effect of monetary policy transmission. But now, as those effects decline, we could start seeing more of a slowing in activity.
I mean, to put it simply, a nightmare scenario would be some kind of spiral. So you have wages going up, prices go up, and then you lose control. Are we there yet?
I don't think so. We are not seeing that in like in the US or in the euro area. We certainly are seeing wage catch-up, and that has happened. That's happened in previous cycles too. We should expect to see that. But we're not seeing wages pushing up prices. The concern, of course, is that if it takes so long to bring inflation down, then you might unhinge inflation expectations and then trigger a wage price spiral. This is why President Lagarde spent a lot of time talking about, the persistence of inflation and the reason to stay high for long.
So is that why interest rates, you think, have to stay higher for longer? Is it really, I mean, it's to get inflation 2%, but really it's to try to break through that spiral that could be impossible, actually, almost to get out?
If you look at projections for when inflation gets back to target, in the euro area, that's the middle of 2025. That's 2 years from now. That is a long time. And that's why it is critical that you can't have any further risks to de-anchoring of inflation, because 2 years is a long time to bring inflation back down to target. To make sure it happens, you have to stay the course and keep interest rates high until you see durable signs that core inflation is coming down. Then, of course, you have to be data dependent.
I mean, all the world's central bankers are here. It was quite exciting for me to see Jay Powell also walk in his sneakers. I don't often see him actually in sneakers or face-to-face. Is the gravitational pull of what the Fed does too heavy to hand for the ECB, but also the Bank of England, the Bank of Japan?
What the Fed does matters for the whole world, including for other major central banks. But I think this is a time when central bankers are coming together also to understand inflation dynamics better. There are still several questions. There's a lot of uncertainty on the outlook. And Sintra is a good learning experience for all central bankers.
How hard is it for monetary policy to counter fiscal policy? And again, because we're seeing inflation rise, that means the cost of living goes up. So it's understandable that politicians want to be there for their citizens.
I think it's perfectly good for governments to want to be there for their vulnerable citizens and to provide targeted support. What is not really good at this point would be to have broad-based support that generates very large fiscal deficits, especially increases in fiscal deficits, that then feeds into inflation. That is a problem. I mean, all the indicators, the fact that we have high inflation now, the fact that debt is high, and we need to build buffers because there are going to be future shocks, all of that point towards fiscal tightening, and that's what we're recommending.
When you look at the big central bankers around the world, and of course, in dealing with inflation and growth, who do you think has the toughest job? Bank of England?
I think at this point, among the major ones, if I put the US, the euro area, and the Bank of England, I think in the UK, the inflation problem looks more difficult than in the other parts because they have a supply shock problem that came from the energy prices, and they also have the demand side, which is very tight labor markets. And if you look at wages, in fact, in England, it is where you see the most amount of wage pressures coming in.
So how do they get out of it? Again, there's also huge reliability on mortgages. So it's not as easy as you just keep on hiking because the housing market is so sensitive to that.
Well, I think firstly, the fact that the Bank of England raised rates by 50 basis points recently in their most recent meeting, I think that's a welcome step. That's a clear signal that they are in the fight to bring inflation down. One of the reasons they've been somewhat cautious is exactly what can happen to mortgages and the housing market. But, there's been an increase in the duration of fixed-rate mortgages in the UK, so you have some attenuation of that effect. And household balance sheets are much stronger than they were in the past. So that should also help.
Tom Keene was also talking about, of course, your outlook and what we saw just a couple of weeks ago by the IMF. Are you more optimistic now about the world economy in 2024 than you were 6 months ago?
We had a projection for the world economy to grow at around 2.8% this year, which was coming down from 3.4% last year, and then going up to around 3%. Our new numbers will be out in July. We don't have it ready at this point. We're getting different data from different countries at this point. But I think the overall story of an economy that's slower this year than it was last year will remain.
So how much of the conversation here is also trying to understand some of these forecasts going forward and how central banks actually can do a better job in understanding the impact that monetary policy has on future inflation?
I think everybody's trying to understand how economic activity is being impacted by the rate increases that have happened so far, because they've been sizable. The expectation was that we would have seen more slowing down already than we've seen so far. So the surprise is on the resilience of economic activity. Now, of course, we don't want to extrapolate and just assume that this resilience is going to continue. So it's a difficult job for central bankers at this point. They have to, watch the data very carefully, but at the same time, they have to show real commitment to bringing inflation down.
Geeta, thank you so much for joining us. Geeta Gopinath there, of course, of the IMF. I also spotted, Tom, the new central bank governor of the Bank of Japan. I have to say it's like a rock concert for nerds. We were quite excited because it's the first time I think he's been traveling for an event since he was made governor outside of Japan. Yeah, the invite got lost in the mail. Lisa was looking for it through her mail today. All I can say, Francine, is you and Dr. Gopinath, I can just see you having the Travestiero at Casa Pequita in Sintra. Lisa, this is very important. It's a sweet, eggy almond cream dusted with castor sugar on top. I'm sure it'll be enjoyable. Francine, thank you so much. Francine Lacroix, reporting from the trenches. I mean, Maria Tadeo goes all these terrible places with ice cold and no coffee and that. And Lacroix is having Travestiero. Well, my favorite is every shot of Maria with her hair blowing around because it's always windy and blustery. It is interesting, the difference between Jackson Hole and Sintra. Sintra, very civilized, and Jackson Hole, very much the rugged American Western lore of, FDR and Teddy before him. They're different, and there's been some discussion of making Jackson Hole more Sintra, and there's real academic pushback to that. Academic economists enjoy the rigor and the almost Jesuit certitude of Jackson Hole. It's really serious about the papers. Mike McKee's all over this stuff. And Sintra is more like a modern conference with people like Dr. Gopinath talking. And good restaurants and I would just, all that. We're selling this. Come on. Qantas, help us out here. Next year, Sintra. We'll take Ferro if he comes back. But to me, the really serious thing here, in the conversation stopped there, is Dr. Gopinath said, well, we don't really know in July what our update looks like. There was a pause there in the conversation. It seems as though people are speculating there may be a tipping point in markets, in the economy, that it's going to happen quickly. We've heard about this rapid disinflation. We've heard this from Morgan Stanley. We've heard this from others. Yes. A lot of the market prognosticators and the economists don't want to come out with assertion and just follow the price action, because that's essentially what we keep hearing from a lot of people in the market as they reassess. We like markets now because the mood has shifted. Is this just price dictating narrative? And Michael Darda encapsulated this yesterday. Nice bull. He had bulls behind him in his backdrop in his fourth house. But Darda really encapsulated it in his caution if it's disinflation with like the IMF declining real GDP as well. Others are more optimistic on that, and that's the battle engaged for July. Coming up next, looking to July always, Kit Jukes, Chief FX Strategist, SocGen. We'll speak to him about what we can read in the leaves of the foreign exchange market. From New York, stay with us. This is Bloomberg Surveillance.
We're seeing very good buying of dollar in our underlying flow data. This carry trade, led by commodity currencies, high yielders, and dare I say it, AI stocks and things like that, that seems to be on the cusp of unwinding. These things on the margins cannot advance much further. So we are looking at risk probably softening in the short term. You don't want tail risk to compound that.
Jeffrey Yu, with massive critical thinking skills across equities, bonds, currencies, commodities, he is a jewel at BNY Mellon. We got to get him on. I think we should, like every third day, have the U hour.
Our people will talk to his people. My AI, my ChatGPT will talk to his ChatGPT.
We'll pay him by the syllable. It'll be good. Jeff Yu there with BNY Mellon as well. Futures up 10, Dow futures up at 13. I like your theory, and I guess this goes to 7:30 this morning. When's Walgreens out?
7, like in 14, 13 minutes.
I think Bramo's onto something here, folks. Just possibly it may come down to what corporations actually say about the market. Heaven forbid it's not econobabble.
I actually think that this may be the tipping point. We saw this with Carnival yesterday. The cruise line are reporting earnings. They've been bid up dramatically. The earnings beat expectations and the stock tanked. Why? Because of how much expectation had been built into the share price and the valuation. Do we see something similar with tech? Do we see something similar with other consumer discretionaries? And to me, Tom, this is the key question heading into the middle of July where we kick it off with JP Morgan.
It's going to be something to see, and all that wrapped around what we're looking at each and every day, which is stasis in foreign exchange. Joining us now, someone who's been of immense value to us over the years. Kit Juke is with the derivative house Societe Generale, their chief foreign exchange strategist. Is there a clear vision to the Juke's memo, Kit? I mean, it's the death of summer. You're going to spend all of July and August in some shack in Spain on the beach. And I just want to know, is there a Juke's vision of where we're going? Or are you like everybody else waiting to see what happens?
There's a vision, but there's uncertainty about time. I mean, this is an extraordinary cycle. But the one thing that I was listening to, reading Gopinath, Gopinath was sort of saying, we're uncertain about the lags. The lags are long and variable, and everybody's impatient for the lag to play out. It'll play out in its own time because the single most unique feature of this cycle is that we ended up with really easy monetary policy, really easy fiscal policy, and really, really tight labor markets because of a pandemic. And then from there, tightening and getting that out is taking longer than we thought. Well, gosh. But so I sit there and think in one of the next 26 Thursdays, I'm going to come in one day and I'm going to see a weekly jobless claims number that makes my mouth sort of hang open. And I think, wow, here we are. I mean, this cycle is going to end. This plane is going to land. But we're completely at a loss to try to figure out how long those lags are. And we're nervous that when it does land, will it land as softly as we hope, and so on and so forth. But I think that vision's super clear. What is terribly difficult is to guess how long it takes to play out.
One definitive thing that Geeta Gopinath said was that she thinks that the UK, your UK, is in the worst spot of all of the central banks in terms of combating inflation. Is this supportive of the pound or negative for the pound because it means higher rates and slower growth?
Well, right now, markets are more myopically focused on short-term interest rate differentials than I can remember them in the foreign exchange market. So right now, the pound's doing well. In the long run, though, if you've got a really lousy growth inflation trade-off, which is what we've got, you have to get rates up a lot, and then you get a worse economic slowdown, and then you'll get more rate cuts. So we are supposed to be taking our pounds, and as strong as we can get them, we're supposed to be turning them into something useful like Swedish kronas, so that this time next June, when the sun's shining in Sweden, I'm on a boat outside Stockholm with my feet up and a glass of beer in my hand, having loads of fun at today's exchange rate, because it'll be completely different by then. And yeah, each week I just kind of sell a few more pounds.
Lisa, you and I got to get our heads examined. Do you see how Jukes talks there about vacation like Pharaoh does? Well, it's like a God-given right. It's like the king descended and said, Lord Jukes, Lord Pharaoh, Take August off.
Well, and I will say, Lord Jukes, Lord Ferro, come do that in the U.S. I'm curious from your vantage point
idiots.
as we look for. No, I support it wholeheartedly, and I will join you on that Swedish boat.
Kid, I need to go to Spain for one day. Where do I fly into?
Oh my goodness!
So the plane can wait
absolutely. Kit, when we talk about our travel plans, let's talk about the dollar. Since we're going to go there, how strong is the dollar going to be versus all these currencies to plan our one-day vacations? And this has sort of been one of the surprising features is, are we entering a reversal period of the dollar weakness of the first half of the year? Or does what we've heard from the ECB, what we've heard from the Bank of England, what we've heard just generally around the world really challenge that and indicate more weakness ahead?
I think you're going to get more weakness ahead for the dollar over time from here. I mean, it's still very strong, and it would be amazing if it didn't actually weaken at some point. We have seen, I think, Jeff, you put it very well. We've seen buying of dollars from people who are trading U.S. exceptionalism in AI stocks, for example, who are trading the U.S. economy is not slowing down yet as a theme, and the market's pricing in the idea that the Fed hasn't peaked yet in terms of rates, and it's pushing a little bit more in there. And there will be some people who will turn around and say that there will never be another U.S. recession because the U.S. economy is so wonderful. As those people get themselves fully priced in, which I don't think is terribly far from here, that's as good as the dollar can get from here with the rest of the world recovering. So you're a bit like me. You have a strong currency today. It's not going to be strong forever. On that basis.
Kit Jukes, frame out the opportunity on the Pacific Rim, and particularly with the shock and awe of yuan. I mean, it is a devaluation of the Chinese yuan. I'll let you decide where that tip point is, but 7, all eyes on 7.15. We blow through that to a 7.23 right now. My eyes are failing me. 7.22 on yuan. Frame out the opportunity on the Pacific Rim.
The Chinese opportunity is that the Chinese have a problem reviving their economy. They don't have much inflation. I mean, these are not big moves in percentage terms compared to what we see in lots of other places. So they could go further. There's certainly nothing to help it now. I worry that China, if it tries to revive its economy, it can't easily go back to the old kind of boost the real estate market yet again. That they'll probably have to make manufactured goods and sell them to the rest of us. And they'll welcome a weak currency to help them do that. So they may get some pain in China. The pain will then spread to the other people who rely on them. It's I wouldn't want to be terribly long the Australian dollar today if they're trying to sell iron ore to a Chinese economy that's struggling. So I think, and you can see this year, one of the features of this year, the strongest currencies have been Central Eastern European ones that fought inflation hard, and Latin American ones that fought inflation hard. There are no strong Asian currencies this year. None of the top few currencies are. I think that's what tells you that the market is kind of getting this to some degree. I quite like selling the other Asian currencies against the yen because the yen's going to frustrate me until it starts going up when they make some policy changes. Mr. Wader could do the world a big favor by getting on board with everybody else today, but that's not going to happen.
I need to extend this conversation, but we don't have time to do it. I really want to talk to Kit Jukes, folks, in the coming days from Spain on yen at 144, 146.48, and back you go to the tension of 150. Kit Jukes, brilliant at SocGen. His morning note, we should explain this, Lisa, and this is really important, and this goes back to the advent of Bloomberg surveillance and, frankly, Bloomberg on the economy. Years ago, we don't talk to each other. This is really important. We don't compare notes in the morning. There's no meeting where we all get together and go, oh, did you see Kit Jukes' note? It's just completely random.
I wish that.
And it works because Ferro sees stuff I don't look at. You see stuff. Every time Lisa opens her mouth, I learn something because I didn't see it. And that's the magic of how we do this.
No one who's listening to this is surprised that we don't talk to each other at all before this show.
No, we do it on purpose. They said, oh, we have to have a meeting. Qantas is like, we got to have a 2-hour meeting at 3 a.m. And I'm like, no, we're not. I don't, let Lisa read what she reads at 9 p.m. at night.
Well, here's what I was thinking about at 9 p.m. last night, because I do have a fantastic life. I'm wondering whether some of the indicators that we're looking at right now are broken, whether the yield curve is broken.
Brilliant.
Whether oil as an indicator is broken, whether we can look at some of the distortions and the rejiggering back to a pre-monetary repression world. Are we in something where those indicators don't work?
Here's my answer, folks, and I go to the great Yale PhD, Edward Yardeni. I think he's dead on. Patience. We had a pandemic. I was so wrong about the pandemic. My grandmother, born in 1907, used to lecture me on 1919 and the pandemic then. We're coming out of a pandemic. It's totally original, as you say, and as Yardeni says, patience. That's where I am.
Geeta Gopinath agrees with that.
Futures up 11. Futures advancing on the Bramo optimism.
Something like that.
We'll leave it at that. The VIX 14.19. We're on radio. We're on television. Please stay with us. Stuart Kaiser, the optimist, next.
We are seeing clear signs of a demand slowdown.
We are slowing, there's no doubt about that, but the recession debate continues to go on.
I have a surprisingly positive outlook.
When you introduce this level of uncertainty, it's hard not to see, auction price levels as quite compelling.
We find that the value of diversification has certainly gone up quite tremendously.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Bloomberg Surveillance on radio and television. It's earnings central here as we get out front of the earnings season. July 14th, it really starts with J.P. Morgan and selected other banks. Now in moments, Walgreens, Boots Alliance. Meanwhile, futures up 10, Dow futures up 14. And Lisa Maria Tadeo with that important brief. She'll join us in this hour with Anne-Marie Horton.
I think it's really telling that you started with earnings, and correct to do so, because we are seeing earnings, and what it is any kind of disappointment is going to get punished severely. We'll go through all the numbers, but there was a slight miss on the EPS, the adjusted EPS, earnings per share for the first quarter, slammed downward, those shares lower by more than 5% at one point. So, Tom, this to me is the question. Will earnings be the tipping point for a market that has otherwise been Teflon?
How many people does Amazon have or whatever? Walgreens, Boots Alliance, merger disaster of the decade. Walgreens from 100 to 30. The total return has been flat over the last 10 years. 325,000 people out of Deerfield, Illinois, and basically they can't get out of their way. I mean, when do we get the restructuring of this train wreck, which goes back to 2014?
As the all-time expert in Walgreens Boots Alliance, I can tell you that, now, look, honestly, there are a lot of questions about the idiosyncratic versus the larger question. The question about how do you compete against Amazon when people can buy online? How do you deal with some of the in-store safety issues that we keep hearing about? And then also the whole cosmetic trend that people keep going after. The larger question here is we have seen remarkable resilience in markets at a time when interest rates tend to go up, and we see central bankers coming out and doubling down, and it is a pandemic-distorted economy that people can't get their hands around.
Just something we're really committed to, folks. We're going to really do this over the next 6, 8, 10 weeks, is really dive more into earnings. We're going to do it off the financial analyst screen of the Bloomberg. It's a huge tool for us here. And just to get the hour started, we've got so much to talk about. Red and green on the screen, I'm going to call it. Futures not doing much. The 10-year yield, 3.73%. Oil under 69. 68.52 on West Texas Intermediate. And Lisa, I'm just going to say, I want you to bring in Stuart here after your brief, but, the basic idea to me, Lisa, is the EBITDA ratio for Walgreens Boots Alliance is 5 cents on the dollar. Their net income is 3 cents on the dollar. Is that a business? I'm not sure it is.
Are you saying that it's not a business?
It's a tough business.
It's tough business, yes.
Business.
Definitely a business. Tough business, perhaps. Everyone would agree on. I will just say that it is the kickoff for the ECB forum in Sintra, the official one, with Christine Lagarde giving the introductory speech earlier. I'm watching the 210 spread in Germany. We talk about the one in the U.S. Yeah. It is the most inverted going back to 1992 at a time when Christine Lagarde is saying there's much more to do. July is basically a given when it comes to rate hikes, and further rate hikes will be on deck. Today, the eco data continues. A lot of housing data, particularly at 9 a.m., the S&P CoreLogic 20 City Index, as well as FHFA data. We have seen massive declines in home prices, at least on average. When we look forward, Is this a passing trend? Is this a lagging indicator at a time when we are seeing signs, shoots of optimism there? I will just say, on the Walgreens point, I want to just give you some of the headlines. Walgreens now sees a full year adjusted EPS of $4 to $4.05. They had seen substantially more than that. And this, I think, they had seen $4.45 to $4.65. This, to me, is the question. How much do we see shares absolutely pummeled, if anything, is disappointing?
There's only one person to answer that question. Walgreens analyst Stuart Kaiser, U.S. equity trading strategy head at Citigroup. Stuart, I know you don't talk about individual stocks, but this is just a microcosm of the earnings battle over the next 6 weeks.
Yeah, and I think, look, earnings have been obviously a very pleasant surprise or a very painful surprise if you've been bearish on a year-to-date basis. I would agree with you. The bar is pretty high going into earnings this quarter, particularly in the tech space. So that's going to be, I think, a very, very strong test. We have seen investors kind of gravitating towards stocks that have strong EPS momentum. This kind of happened ahead of last earnings season as well. So, when the bar is high, you try to go with the stocks I think you feel like you can rely on from an earnings perspective.
What do your securities analysts say at Citigroup? They've got this. I get all the feed from Citigroup for some reason. And, Jane Fraser, she's long on, IBM. I hear about it first. But the bottom line is, what do the troops say about this pending season?
Look, I think it's going to be a mixed bag. And I think the question is, where do you put the most focus? To me, a lot of, to continue the Walgreens conversation, it's the services side of the economy and it's the labor market and consumer spending that are the things I think you need to pay most close attention to going to the second half of the year.
I'm looking right now at Walgreens shares down 7.4% in pre-market trading on the heels of this disappointment. It wasn't a severe disappointment, but it was a disappointment. What does that say about the potential sell-off if there is any crack in any of the big tech names, given where valuations are, given where expectations are, and given how lofty some of these stock prices really are right now?
Yeah, look, it's going to be a minefield, I think, for tech earnings. And the tough part, too, is you look at that week between July 24th and July 31st, you get the FOMC, and that's when you get, large cap earnings. So, that last week in July, I think, is going to be very busy for you all and obviously very busy for us. And yeah, to your point, I think the bar is very high here for a lot of those stocks, particularly if you look back to last quarter. A stock like Microsoft, a stock like NVIDIA, which were considered consensus longs, still managed to rise considerably on earnings. And I think they now face the challenge of backing that up.
Headline out right now, Delta Airlines thanks the Abramowicz fan for profit-making travel in July.
Thank you. Yeah. Are you just basically
it just continues.
tweaking my...
Walgreens tanking as we go, and Delta out with a complete redo. Lisa, why don't you visit it here? Free cash flow was greater than $2 billion. They popped FCF up to $3 billion. I believe that's a 50% lift on free cash flow.
Well, this has been the perennial story, right? That people keep traveling, that the distortions post-pandemic have continued. Given some of these post-pandemic distortions, and we were talking before we went on about how people do keep on spending, and maybe they were conditioned by remaining cooped up and feeling like they have to seize life at the horns or whatever kind of psychological rationale you want to put on it. But Stuart, how does that color your view of whether you're more optimistic or more pessimistic once we get the reality of these earnings?
Look, I think it's earnings, and to your point, is consumer spend and employment. And if we're going to have a recession in the second half of the year, it's going to have to come from the consumer side of the market, right? So that's why there's so much focus on the labor market. I think going into earnings, there's a high bar for tech, mostly because tech has been leadership of the market, and I think there's a high bar, a lot of focus on consumer companies just to see if the spending is following through. Are they continuing to be able to pass through inflation, or are they starting to have to discount, to get people in the door? So I think those are the two areas we'll probably focused on the most for earnings coming up. Is can tech hit the bar, and what signal are we getting on consumer spend?
What does it mean that tech earnings is a minefield? That whole period is a minefield at a time when you've been pretty optimistic about where the market's heading?
Yeah, look, the tech trade is obviously not, as we've said, as clean as it was, at the beginning of the year. And I think the bottom line here is if you look at sales revisions, if you look at EBITDA revisions, they've been, higher for tech and even higher in the AI space. So that kind of sets your bar, a little bit higher for expectations. And what we've seen the last I would say 1 to 2 months is long-only investors in particular starting to have some fatigue in terms of tech buying. We're starting to see some outflows from the space. So you put those two things together, you have a high bar and what looks like some fatigue on the institutional side, and that just, to your point, sets it up that you need to deliver results here to kind of justify your performance on a year-to-date basis.
I want you to talk to market timers right now. You have been brilliant, Bale and the rest at Citigroup, about saying you got to be in the game to win. Talk about market timing right now, the efficacy of being hyper cautious versus the optimism I hear from Citigroup.
Yeah, look, I think even our optimism is starting to get a little bit tired, to be completely honest with you. Partly it's price action, and partly it's one of the reasons we were kind of more bullish coming into the year was so much stock had been sold last year. And we thought that those positions kind of needed to be rebuilt. And just the data we're seeing on flows suggests that those positions have largely been rebuilt. Call it you're 75% of the way, along that path. So from our perspective, it does kind of impact risk reward a little bit. So look, we are still relatively positive. Gun to our head, we'd say up rather than down at this point. But the risk reward is definitely.
But that's the nature of a bull market. I mean, I'm sorry, we're not in the first leg off the mat. Bramo was wicked gloomy the third week of October last year. And guess what? We all got off the mat and went. It's not supposed to be like that now, right?
No, it's not. I mean, for a number of reasons. One is you've had a tremendously positive economic data surprise to start the year. That's flowed through to earnings expectations as well. I think that's helped lift the market. But look, you get above 4,400, and it looks like institutional investors at least have started to just sort of call pause a little bit in terms of their inflows into the market. So that means one of two things. Either I think you need to take recession risk out of the system, which would be your next leg higher, or you're going to need, retail to continue to sponsor this market to the upside.
Are you one of those people who says if there is a sell-off in tech, it's a buyable dip? That's what I keep hearing from everyone.
Look, I think if there's a sell-off in tech, I think that means markets are down in general. You're not going to get tech down with markets up, right? So every dip is a buyable dip, I guess. But, from our perspective, I think if you get a pullback here, I agree with you. I think there are a lot of people waiting to get into the market, a bit lower, which probably means right now we're in the pain trade to the upside. People didn't want to chase it. I think what you'll probably have is people buy a little too quickly on the way down and then kind of have to average themselves in. The floor is clearly higher than it was to start the year. I agree with you. I do think you'll see, I don't want to call it value picking, but you'll definitely see some people who'd be happy to buy the market, call it 5 to 10% lower here, which, as you know, limits the downside. Right?
I don't know if you knew this. This is brilliant, Stuart. Thank you so much. But Bramo's got the East Bay 44 from Grand Banks on delivery later this summer. Gorgeous with a light blue. And
I don't even understand what he's saying.
She's named it Buyable Dip. It's just great. It's a picnic boat for Bramo to have a picnic boat. It's like the Hinckley one, but I think it has more character than the Hinckley picnic boat.
I think I got lost in the blow-up paddle board instead. That's sort of my speed, but
the
carry on.
Hinckley was great. I love the side thrusters, but I'm sorry, the East Bay's better. And you might.
When was the last time you were on a boat? I mean, come on. When was the last time?
My boat was called the USS Dramamine.
Yeah, exactly. That sounds more like it.
Well, Stuart Kaiser, just brilliant. Come back. Bring Jeff Yu with you from BNY Mellon. Do it every day. Kaiser and you. Stay with us. Futures up 9. This is Bloomberg Surveillance. Good morning.
Tom, let's dig into some of these Walgreens details, because I do think that this is interesting. Just to reiterate, they do see the full year adjusted earnings per share of $4 to $4.05 versus a previous estimate of $4.45 to $4.65, saying guidance reflects consumer and macroeconomic conditions. Again, is this going to be the weather, macroeconomic, or is this going to be something where you dig under the hood and it is a select group of people that are getting disproportionately affected by inflation and by maybe a softening market or softening economy?
I would say that in each and every battle of contraction, slowdown, growth recession, outright pain, which nobody's really calling for right now, it is lumpy. And I don't like the phrase rolling recession. I've never liked it. I've never seen a real quantifiable study of that. Maybe David Rosenberg can correct me on that, or the great Ed Hyman. But the bottom line is, it's lumpy always, where some things win, some things don't. And some of that's due to technological change.
In other words, Amazon stealing their lunch. And how much is that really what we're hearing? And not just Amazon, but we're seeing that from Walmart, too, which has really improved some of their online presence. You have to have a certain amount of investment to then get the critical mass to finance the new world, which is a, tech-induced
It is the effect
shopping.
of technology on all this. And the Amazon off the mat, I mean, let's recall 180 to 80 on the pandemic overbuild. Thank you, Jeff Bezos. And Joseph, they're back a third. They've gone 80 to 127. That's the great Seattle bounce. That was my technical analysis for
fantastic.
the day. Stuart's over here taking notes. Coming up in the next hour, Cameron Dawson will join us here in the 8 o'clock hour. Looking forward to that. I'm watching oil, 68.44 American oil. Good morning.
We gave Putin no excuse to blame this on the West or to blame this on NATO. We made clear that we were not involved. We had nothing to do with it. This was part of a struggle within the Russian system.
The President of the United States delicately yesterday within the Russian system. President Biden there speaking on all that we've seen out of Russia in the last 72 hours. We were hugely valued yesterday by a brief by Anne-Marie Horton, our Bloomberg Washington correspondent, with all of her heritage of travels within Russia over the years. And of course, foundationally with Maria Tadeo in Brussels. And they join us today for a morning brief. Maria, I'm going to go to you first. Can you describe to me what within the Russian system means? The president used that language, and I'm fascinated by your interpretation. What is the Russian system right now?
Yeah, President Biden, who came out and said this is not related to NATO, I think at this point it's pretty clear what this was about. This was an internal power struggle. And today, Alexander Lukashenko, the head of Belarus, also said that. He said, quote, "We let the situation get out of hand." Probably when he says we, is Wagner, it's Putin, and it's also himself, who's now in the midst of this deal. Now, in terms of today, Tom, what we see this morning is a real effort, not just the optics, forget about the optics, but also in the actions by the Kremlin to say this crisis is over. It's clear there has been an ultimatum that's been given to Wagner. You give the weapons, you go away, and the troops, you either join the Russian army or you're out. And then again, this idea from Vladimir Putin today, saying and repeating, you averted to his troops a civil war, and now we go back to normal. To me, the big question now is how will this affect the war in Ukraine? Because Wagner performed better than the Russian army.
Anne-Marie Horton, within the Russian system, your perspective on how the institutions of Washington should react, particularly if the Russian system has 1,674 deployable ICBMs pointed west.
Well, I was actually struck by Viktor Orban's comment in an interview he gave to Bild, which he said, if someone speculates that Putin might fail or be replaced, then they do not understand the Russian people and the Russian power structures. What he is talking about is the power structure that this is, in essence, a military and a security state, the FSB, the military, obviously the Kremlin. None of those agencies came behind in support of Yevgeny Prigozhin, and that is why this was obviously a failed mutiny, and it dissolved very quickly, even though Putin had to step in at the brink. My question is why he did not get in sooner, when for weeks and months he knew that Prigozhin was just exasperated with the military. I was also struck yesterday by what we heard from Admiral John Kirby when he was asked continuously at the briefing room about does this weaken Putin? He didn't want to go there, and he said Putin still maintains a tremendous amount of power. Yes, individuals are speculating that, given the fact that this was the first time really since Putin's rule that we've seen this type of mutiny and rebellion against him. At the end of the day, if you look at what's happening in Russia today, he convened the heads of the top agencies yesterday. He is speaking at the moment to Russian servicemen and military. This is an individual who still maintains a tremendous amount of power, especially when it comes to the Russian military, which John Kirby says all of it is in Ukraine right now.
Anne-Marie, another thing that the U.S. officials said yesterday was that the nuclear threat was not seen as elevated. They did not seem to lean into this idea that this raised the risk of nuclear proliferation or any kind of elevated chance of extraordinary measures taken by Vladimir Putin. Do we have any sense of why they could say this with such assertion?
Well, at the moment, if nothing has changed and Putin is still in power and they have not changed how they want to assess his nuclear use in the past, that has not changed for what they view it as today. But what I would say is that officials are concerned that given that this is going to obviously mean Putin, who is already very paranoid, becoming more paranoid, there is a potential he doubles down. And analysts suspect this could mean he becomes even more aggressive, and that could potentially use to the use of either nuclear weapons or more violent weapons. But at the moment, the U.S. does not see a need to change their posture. I think there are still a tremendous amount of questions in the United States about what happened this past weekend than answers. And I think that is something the president, Admiral Kirby, were really trying to get at. And the point they really wanted to get across, given the fact of what we heard from Putin in the past, whether or not it was blaming then Secretary of State Hillary Clinton about protests in Russia, whether or not it was blaming the United States about Russian-backed leaders in Ukraine in the past that were ousted, they always blamed the West as meddling in internal affairs. And President Biden really wanted to get ahead of that narrative.
Maria, there's a real question of how Ukraine is going to use this opportunity to potentially make inroads in the conflict, in the war that Russia has been declaring on them. Do we have any sense of how they are going to try to use this to their advantage? Are there any early signs of that?
There's two things. One is obviously the optics of this. And I spoke to a Ukrainian official who said, OK, there was a mutiny. And of course, now Vladimir Putin seems to have calmed the situation down. But already it shows, and this is what they insist and have persisted for a year, that Russia is not an invincible country and that Vladimir Putin is not this all-powerful KGB man. There's a myth to that story, too. To me, the real question now is, if you have Wagner that gets incorporated into the Russian army and it's Shoigu and it's the Russian officials that handle this operation, is this a good thing? Because we've seen the reality is that a lot of the heavy fighting was done by Wagner, and there's serious questions as to how the Russian army has handled this situation. On the battlefield, the Ukrainians say if that continues, it could be a competitive advantage. They also repeat it is too early to say whether the counteroffensive is going well or not.
Maria Tadeo, thank you so much. Greatly appreciate it this morning in Brussels. And Anne-Marie Horton in Washington. Look for Balance of Power tonight with Anne-Marie Horton and Joe Matthew as well. Red and green on the screen on the data front. Red and green on the screen and yield as well. 10-year yield flat. I am watching oil. We had a 69 up to 70 level yesterday. We've drifted down $1 all into a 68 handle on West Texas Intermediate, 68.39. Brent crude threatening a 72 handle. We're not there yet, 73.12, down a full $1 on Brent crude. And to triangulate that back to China, renminbi was a 7.24, fractionally stronger, 7.22. I thought Kit Hughes was just brilliant on the noise of foreign exchange forward.
Particularly with UN. I mean, China's been intervening in a much more significant way as they try to stave off some of the losses. They've been somewhat concerned that their previous efforts didn't work. And this has been a big issue and the big question mark hanging over global markets. And I wonder how much oil is a litmus paper for what people perceive China as having going on versus some larger question on the state of the global economy.
Can we say that Delta Airlines lifted the markets? I think we can possibly allude to that.
Is that a pun?
No, well, up and away. Wait, that's another company. But the answer is NASDAQ up 0.4%, and it wasn't Walgreens Boots that drove the NASDAQ up 0.4%.
No, Walgreens Boots is not doing so hot. There is this issue, though, where we've seen transportation and airlines in particular continue to just blow it out of the park. They said that they see full year adjusted earnings per share at the high end of $5 to $6. They had seen $5 to $6, but it's sort of giving a sort of guidance given the strong demand from people like myself who are, taking vacation with their kids.
I think 16 lines on the ECO screen says it's a Mike McKee day.
Oh, yeah.
I mean, it's just we haven't really talked about this here at 724 in New York. there's a wall of economic data today.
It's not just housing prices.
Tons.
We get home
Durable
sales at
goods.
10. I'm really curious, actually, to get the Dallas Fed services activity. We got the Dallas Fed manufacturing activity yesterday, and it was really disappointing. This has been something people have been pointing to as a recession warning, one of those indicators everyone ignores. Do we get the same kind of downward trend in services, which would indicate not a rolling recession, as you say, but something that is a little bit more consistent and unified?
Well, I'm going to look at this. I've never looked at the Dallas Fed Services Index. I'm sorry.
A shock face.
And the answer is sort of a leveling, and then the pandemic crush, the rebound off the Biden stimulus, and it peaked out the summer of 2021. Let's call it 2 years ago, and it's ebbed down. And unfortunately, Bramo, as usual, is correct, and I'm not. If it breaks down from here, it's a big deal.
That's what some people are saying, maybe.
Folks, please stay with us. Team coverage on the Dallas, Texas Service Sector Outlook General Business Series from the Federal Reserve Bank of Dallas. We'll bring that to you only on Surveillance. Futures up 7. Good morning. Bloomberg Surveillance. Good morning, everyone. Jonathan Ferro on assignment. Lisa Abramowicz and Tom Keene holding court in New York. Across the markets, there's some nuance here to a large body of economic data this morning. 10-year yield giving me an nudge, 3.72%. We're going to talk a lot right now about that yield, maybe what it means to the housing market as well. Red and green on the screen. NASDAQ futures up 0.4%. Gets my attention this morning. Lisa, I looked at a bank. It doesn't matter which bank it was. It's in the news. But I looked and I just wanted to see what a CD rate is. And the answer's higher. It was a 13-month CD. And I looked at the yield and I said, oh, money market-like. They've really come up.
They need to, because people are aware and they're not going to go into those CDs, those instruments, unless you get that. And that's going to be the flight that we keep seeing potentially from banks. Can I give you some names?
Yeah, we're going to dive into that. And what do you got? Names?
Walgreens. I want to take a look at Walgreens. Really interesting. Just to sort of reiterate what we've seen there, down almost 7% after slashing its full year forecast for adjusted earnings per share. Also saying that it's because people are spending less on COVID and they got the flu less. And also people just have less income. What I find interesting is this. This is a profit margin story. Revenue in the first quarter was $35.4 billion, which beat expectations by more than $1 billion. And yet still their earnings per share disappointed. And to me, the margin story is what I'm watching all around.
I don't know what to make of it other than, is it been a challenge? I mean, there's just no other way. It goes back almost 10 years now. Not to equate it with Bed Bath & Beyond, that's inaccurate, and not for the many thousands of people that work at Walgreens, not appropriate. But nevertheless, there's that tinge to it of this is just taking forever.
Well, especially when they're trying to complete the merger, but also gain some headway with respect to cosmetics and such. Delta, you talked about that. They raised their guidance for 2023, and they reiterated guidance for 2024. Also interesting, they said that they expect the free cash flow to total about $3 billion this year, up from $2 billion previously. Those shares up about 0.7%, but they've already gained so much. Tesla is fascinating to me. This is really one of the big bellwethers for the market. Shares up about 1% today. They were down more than 6% yesterday after Goldman Sachs downgraded the recommendation on them. It was the biggest sell-off since April. People gaming out whether Tesla will be the bellwether in terms of not necessarily delivering the expectations that people are looking for with respect to their electric vehicle charging network, as well as just in general, the dominance in the EV space.
Let's do this now. Let's go back and swing from the equity markets back to the bond market. As Lisa and I were talking about, there's an adjustment in yield. Somebody fully on board with that. The last time he was on, he was mesmerizing. He's managing director, strategic income with lots of mortgage experience, Eagle Asset Management's James Camp. James, thank you so much for coming back to the show. I'm not going to mince words. You've got that St. Petersburg clarity to your writing, and it's real simple. You are looking for a 4% 10-year yield. What does our world look like if we get a 4% 10-year yield?
Well, Tom, good morning, and Lisa, good morning. It's a slowing economy, and I think the Federal Reserve has basically told us the only way out of the inflation conundrum is to have a recession, and I think we should take them at their word that they're going to continue to push on short-term interest rates, and there will be some follow-on effects with longer-term interest rates to get this economy to slow down. That's really the only way out of the conundrum that we're in with inflation. So I think what happens this summer is we're going to have the lowest CPI print that we have all year in June because of base effects. We've talked about that quite a bit. Those get easier to beat as we move into the July and August months, and the Fed's going to have all of the cover that they need to continue to hike. So we think we probably top out at a 4% 10-year yield. It'll be a big buy for us as fixed income allocation at that point. But that's where we think we hit intermediate term.
I mean, your work in engineering and bringing it over to the dynamics of mortgage security, let me ask an open question. If we get a James Camp world, what does the housing market look like? What do mortgage securities, what do commercial real estate look like?
Well, it's going to be a challenge, right? We really haven't ever replaced the financing model for residential mortgages post-GFC, and we sort of have a cobbled together secondary market for structured product. We also have a banking system now that, although I think the crisis, quote unquote, is behind us, we have very tight credit conditions and we have bank balance sheets that are still under stress. So credit availability in the mortgage side is going to be limited. And I think it's going to show, that the mortgage market has kind of had a little bit of a bounce here. That's pretty typical late cycle stuff. I think mortgage markets and the housing market probably slows in coincidence with the economy slowing down back half of the year.
James, when you talk about this tightening in credit, I think about this Federal Reserve paper that came out over the past couple of days. And in this paper, it said the share of non-financial firms in financial distress has reached a level that is higher than during most previous tightening episodes since the 1970s. Why are we not seeing it in credit valuations? Why are we not seeing it in a more dramatic increase in bankruptcies?
Because it happened so quickly. So because it's 12 months ago, we were at a 1.5% funds rate. The balance sheet was still expanding and M2 was still expanding. I think people need to remember that we're only 12 months into this cycle. It's been a very steep, very abrupt move, and the effects of which, we talk about inverted yield curve, et cetera, they're not going to show up right away. And right now what we're seeing is those things are taking hold in the economy. We're finally getting to a real interest rate that is positive, credit conditions that are really tightening, and the Fed's work is really just starting at this juncture.
We always think about stock traders who talk as though they are bond analysts, and increasingly we are looking at bond strategists as increasingly stock experts with respect to valuations. How much are earnings from some of these companies going to be a tipping point, not just for the equity market, but also bond markets as they look out to possible disappointments that, as we just heard from Stuart Kaiser, might be a real catalyst to the downside?
Lisa, it's a great point. It's why we work hand in glove with our equity counterparts for income and income generation. As you mentioned earlier, there are companies that are pushing top line revenue growth, nominal growth very well because they've had pricing power. Once that pricing power erodes and we're seeing consumers tapping into savings, we're seeing credit card debt go up exponentially. We're seeing the cost of that debt go up. You're going to see the pressure on margin. The sticky part of the inflation story is labor. You don't have somebody come into the office or come into a job at $20 an hour that's going to turn around in return for $15 an hour. So that margin compression is very real. Companies are not going to be able to continue to push price, and the underlying cost structure, we think, has some inertia to it. So margins will come down.
What do you feel? And, it's a fixed income chat, but James, I'm going to ask you about the equity market. Do you think it's extended and vulnerable, or are we near a second leg of a bull market?
I think it's unequivocally extended and vulnerable, and I think it goes exactly to the point of where did the growth come from? It wasn't necessarily unit volume. It was the fact that the companies were able to demand, for the first time in decades, higher prices for their goods and services because the consumer was flush. As that consumer works off those excess savings rates, which we're seeing in the data, the underlying cost structure, because of the labor market, is going to continue to put pressure on margins. Look, the labor market has a seat at the table today. This is a different world than pre-COVID. I don't think we're ever going to go back to an environment where labor doesn't have some negotiating and some ability because of work from home and other dynamics to really push. And so I think margin pressure is very real. And I think that's where the equity markets are going to begin a correction, probably Q3, Q4 this year.
If the Fed adapts and adjusts to a James Camp view, what is the asymmetry at 4% on your 10-year yield call? I mean, it could easily blow through 4% given a set of events, right?
It absolutely could, but I do think that the Federal Reserve is going to get what they want. I think they're going to get their recession. I don't think they're going to move off their 2% long-term mandate, which perhaps is unwise, frankly, given the secular changes that we've seen in the economy. But I think ultimately when that happens, you're going to get a reasonably quick about face in Fed policy. And remember, 2024 is an election year. If we do get the slowdown that we're calling for, Q3, Q4, and we get some unemployment numbers that approach 4.25%, we may be looking at early 2024, early spring of next year with a pretty aggressive about face in the Fed. And that means that bonds are going to have a tremendous tailwind from a total return standpoint, because they're already starting from the most generous yields we've had in nearly 15 years.
And this is actually increasingly consensus. We have almost a 0.5 percentage point of a rate cutting cycle priced in next year for the first half of the year. James, are you basically saying if we do see that weakness in the equity space, that bonds will once again reprise their inverse correlation with the stock land, and really the 60-40 kind of portfolio arrangement will retain some of its past glory?
Lisa, 100% agree with that. 2022 is the anomaly. We had correlations across asset classes across the board. Again, it was that abrupt sea change, that regime shift that happened seismically and quickly on the capital markets. And I think the 60-40, the balanced approach, free cash flow from dividends, free cash flow from dividend growth, and the most generous bond yields that we've had make investment in the income space, frankly, as sanguine and as a low vol proposition as we've had in quite a while. And that negative correlation is back.
James Camp, thank you so much, with Eagle Asset Management in Florida. Red and green on the screen here. Camp driving yields lower, 3.72% on the 10-year. I'm kidding there, of course. What I find fascinating about this is, what does the Bloomberg Total Return Indexes, plural, do? There's 8, 9, 10 of them. And just to take the blended total return index, price up, yield down, has been really challenged here. No one's looking for, as Mr. Camp mentions, lower price, higher yield on a blended basis. Everybody's rationalizing, yeah, for a moment we'll do this. What if it just breaks down again?
We just had the worst sell-off in the bond space ever, right? I mean, yes, last year
ever's the
was
operative word.
an unprecedented year of declines at a time when credit quality still isn't terrible. We did not get a bankruptcy cycle. In fact, Torsten Slok of Apollo Global Management put this out this morning, basically saying that the quality of auto loans and mortgages, not to mention a lot of corporate credit, is a lot better now than it was 10 years ago because of the nature of how things have matured. If that's the case, then you have a ballast there, the equity-like component of credit versus the benchmark question around where we go with rates and longer term inflation expectations.
I would bring it over to who gets not a real wage gain, because you may not get a real wage gain, but gets a better, worse wage gain than many other people in society. I think it's going to be fascinating to see, say 2 years out from now, where real wages end up. Right now, the VIX 14.27, down negative 29 points there. Standard & Poor's 500 were up fractionally, up 0.2%.
You talk about the labor market, Tom, and to me, this is the mystery of what happens next. KPMG, the story in the FT yesterday, cutting 5% of its workforce because of the slowdown in demand for consulting and other services. We've seen, 11,000 job cuts announced by a lot of the Wall Street banks. Ford announced overnight that they were going to begin cutting jobs today and tomorrow in some of their salaried workers. Yeah, this is all coming as the unemployment rate still remains pretty low.
And percolating on this, folks, is something that it is in the zeitgeist, but I think it's going to be a lot more. Is this a white-collar slowdown? And boy, 74, 75 was not a white-collar slowdown. It was a blue-collar disaster.
People are saying it is. It's a white-collar recession.
You know, it's going to be interesting to see how that is and what percentage of that was just the overhiring within the pandemic.
It's a great point.
And I think that the jury's out on that right now.
I think you're correct, which is the reason why a lot of people aren't necessarily saying this is going to increase the unemployment rate materially.
Quickly, what's my story of the day on the Bloomberg Professional Service? Bloomberg reports, and this is the wonderful Anya Andrianova on Japan. She picks on T. Rowe Price, Sebastian Page in the House down in Baltimore, and this is on the Bank of Japan. T. Rowe Price says they will surprise, they will finally give way. It is out at a yen of 150. Euro yen is extraordinary. That's what the adults like Kit Jukes look at. Mark McCormick at TD Securities, and you've got Euro yen out to a 157. Not a never level, but in recent history, strong Euro, weak Japan. This bears careful watching. Anya Andrianova with that reporting from Bloomberg. Coming up, we look at commodities. Darwei Kung joins us. This is Bloomberg.
We need to bring inflation down to have sustainable growth, which is why it's super important to do this. This time around, since it's not just a demand phenomenon, we've had supply disruptions correct themselves. We've had energy prices come down. I think both those factors are helping bring inflation down without needing too much of a hit to the economy. But I think we have to wait and see. We're only just seeing the effects of monetary policy work through the system now, and we could see much more slowing.
We will have to wait and see. She sounds like the economist she is. Geeta Gopinath, the IMF First Deputy Managing Director. This is from Sintra. For our American audience, tough sledding for Francine Lacroix and company. Sintra is, think of the movie Frozen, let it go, outside Lisbon. I mean, that's basically what Sintra is. It's this gorgeous 18th century, 17th century set of little chateaus and fancy places where fancy people live. And it's where the ECB holds a summer confab. With Lagarde speaking earlier today. Tomorrow, we will give you complete coverage of central bankers showing up with microphones on at Sintra. Francine Lacroix leading our coverage there. Of course, look for Francine Lacroix and the Pulse. We'll have it for you from London. On New York time, I believe it's at 4 a.m. New York time. Red and green on the screen right now. And right now we look at commodities. An important study right now, as Lisa Abramowicz was mentioning earlier. Darwei Kung joins us, portfolio manager, head of commodities, DWS, this morning. Darwei, is copper something we should study? I mean, you're the grizzled veteran here. Is copper the commodity to study to get a gauge of China slowdown or growth?
Good morning, Tom. Good to see you again. Copper definitely is very important. It really covers one particular part of the Chinese economy, the industrial part of the Chinese economy. Right now, we're seeing a lot of weakness coming out of that area. And the copper price definitely reflects that. Copper price also reflects the expectation of potential future support from Chinese government to boost either both the property market or infrastructure or other part of economy that's more pertaining to the manufacturing side, industrial side of Chinese economy. And we do see a lot of weakness on that right now. And it's not surprising to see copper price coming back down from $8,600 per ton, given there's been lack of any sort of official communication on that.
Dr. Gopinath just on with us with the IMF, and I'm sure you saw, Darwei, their call 10, 12 weeks ago for shockingly tepid global growth out to 2028. If we get an IMF call out to 2028, what does supply and demand dynamics of commodities do? I can't imagine. I don't think we've ever been here.
That's very, very clearly very pessimistic view of the global economy. One thing I would say, though, is even though the demand side clearly would be impacted by that, the supply side is surprisingly disciplined across the board by various producers, both in the metal side, mining side, as well as on the energy side. We do anticipate very tight capital spending. That's actually been the case for several years now, where mining companies are focusing on paying out the cash flow to investors, to equity investors, rather than trying to come back with large capital projects. So we do anticipate discipline in the production side of commodities. That said, if we actually have very severe negative downturn for growth, clearly we will see surplus across the board for commodities as well.
Darwei, you are among many strategists who got it incorrectly in terms of the incredible demand for crude and the lack of supply on the heels of Russia's war in Ukraine, on the heels of the recovery over in China. As you look into the next 6 months, do you see that this is just a move that's been delayed with prices of crude going up, or do you see this as a new paradigm with a lot of other factors taking away some of the old rationale?
I think one of the things we did not foresee when the war first broke out last year was how much inflationary pressure would trigger the Fed to raise interest rate as aggressively as they did, and what impact that would have to not just U.S. economy, but also global economy. The second part we didn't foresee as well was the response from Chinese government with respect to keeping the economy growing and the determination to turn inward to domestic consumption. And that economic policy shift had dramatic impact on demand for commodities as well. We do see, though, those two factors playing out, not that we don't see any new demand, just the new demand will come slower. So we're anticipating the price to rise from here for oil in particular. By the end of the year, we're anticipating balance to go back into deficit again. And we're anticipating price go up. Our forecast right now for June of 2024, a year from now, is $87 for Brent and $84 for WTI, higher than where we are spot price and the forward curve as well.
When you talk about demand coming online, Delta came out with their forward projection this morning ahead of their annual shareholder meeting, and it was an increase yet again. The pricing power, incredible. The amount of travel has just blown away all expectations. Why do you say that we're not necessarily seeing that much demand, that we're still seeing the ramifications of a rate hiking cycle that defied a lot of what people thought?
Well, that's a great point. We do see a bifurcation of demand. So if you look at the service PMI, still very strong across the board globally, and demand for both air traffic and ground traffic have been very robust. The actual realized driving data, flight data is above expectation and actually above 2019 level, pre-COVID level. However, if you look at the industrial side, so the heavy vehicle use, industrial production use has been coming down quite a bit. And the manufacturing PMI also reflect the same story. Very negative PMI prints across the board. Only a couple of countries are exceptions, but most other countries are below 50 and significantly below 50 on manufacturing PMI. That has a dragging effect. That's a drag for oil demand. And balance of the two is still positive from our perspective. It's just that, unlike the past years, we're not getting both barrels firing at the same time.
Darwei, one final question. The whole electric vehicle ballet, lithium batteries, what's it going to do to your hydrocarbon world? What is the EV impact, the effect upon Brent demand?
Great question. I think the short term, the impact is actually very limited. China has been the best in terms of adaptation for new vehicle purchase on EV. So over 3 million vehicles year to date so far. About 30% of the new vehicle sales are EV vehicle. Their target is 100% by 2030. Europe is second, and US is by far the third last amongst the largest buyers of vehicle. With that positive number, it's gone up quite a bit year over year. The growth rate year over year is significant. However, compared to the base of 100 million vehicles outstanding that's on conventional fuel source, I do think that in the near term, we're going to see oil demand to continue to scale to traffic. But by 24, 25, we should start to see some turning points on the traffic. And by 2030, we'll probably see some level of peak for ground transportation demand, and at that point, we'll see the EV part of the transportation to be more dominant compared to the ground transportation.
We got to go longer on this next time. Dari Kung, thank you so much with DWS there on commodities and all the mystery of China as well. Lisa, I haven't done any homework on this other than to say we're focused on who's going to get Tesla recharging on electric stuff. And you got the whole lithium battery disaster in New York City of buildings literally burning down because, there's all these inflammatory stories. But the mother of all stories is if EV really entrenches, what's it do to oil demand? And I really haven't seen a killer study on this.
Well, the AAA study on automobile use in the U.S. came out yesterday, and it indicated that there is a record amount of travel planned and already in effect during this summer season. And yet we're not seeing the translation into record demand for gasoline. That's the issue. With respect to China, how much of that is a story there as well? Given that there's a much more inward look, domestic travel, domestic consumption, there is a much greater adoption of electric vehicles over the nation.
I have to admit, all my radar is up on this. It just sounds like a free lunch. And from a thermodynamic basis, I'm going, I think my course has said this can't be a free lunch.
I think that
we're like free lunching it into 2004. Red and green on the screen right now. Futures up 3. Stay with us. This is Bloomberg Surveillance.
Inflation is slowing, and by a year from now, inflation will be back down pretty much where the central banks want it to be.
The global economy has held up a lot better in this first half of the year. Inflation has as well.
The core inflation rates, they are coming down, but they're still elevated.
The Fed simply raising rates to a historically still low level is not going to be enough to get inflation under control.
Now, we're not expecting a ton more rate hikes from the Fed, but it does seem like one is likely.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
The markets seem to be Teflon, even in the face of a hawkish ECB, a hawkish Federal Reserve. Good morning. This is Bloomberg Surveillance on Bloomberg Radio and Television. Tom Keene, Jonathan Ferro, and Lisa Abramowicz. John is on vacation. Tom Keene, we are looking. I know you can't pronounce the V word, vacation, which is what we're looking for.
Ischia, something like that. I can't pronounce where he is.
Honestly, it seems like this market wants to rebound. It had a couple days of sell-off, particularly led by tech stocks.
I agree.
And
totally
right
agree.
now, it wants to just sort of, are people buying the dip? Was that a dip?
With the dip and what we had with Anne-Marie Horton and with Maria Tadeo early here on all that's going on with Mr. Putin, it hasn't affected markets. You were way out front on this, and you see it again with oil, 68.06. I may get a 67 on West Texas Intermediate, but still the market's resilient.
I feel like people are saying, we can have every existential worry in the book. We have for the past 12 months, 24 months. We're sick of it. If you look on the ground, it looks pretty good. And then, oh, wait, but what about the earnings? Have we built in expectations that are much too high relative to what some of these companies can deliver?
Well, we're going to have to see on the earnings front today. Grimm, Walmart's, Boots Alliance, train wreck for 14 years or whatever it is, 10 years. And Delta Airlines flying away at Bastion, getting it done along with the rest of his business class industry.
And yet Carnival yesterday beat expectations. And then
Carnival
their
did
shares,
well. I missed
but
that.
their shares then tanked, right? So how much had already been built into the expectations? To me, I wonder if we move beyond this question around hawkish central bank speak, because we have heard from Sintra this morning. Christine Lagarde coming out very hawkish, more hawkish than a lot of people were expecting, saying they're going to raise rates again in July. Their work is not done. This is a real pricing pressure that they cannot help but to continue to fight. Will markets just simply stop responding?
I think we're going to wait for data, and it's going to be the earnings data that you and I have emphasized today, and also as we get to the Fed meeting, what we see with the jobs report. That's got to be. I don't even know when Jobs Day is. Let's get out. We go to the Bloomberg terminal for this because no one's the interns. Did you notice the interns are weaker this year than last year?
No, absolutely not.
I have 4 interns with me. Good
Disclosure,
morning, Chapel
we don't
Hill.
have interns,
And
so no one's being
I have 4 interns with me, and I said,
one.
"Do you all have air conditioning?" and only 2 of them had air conditioning. There's 2 of these kids are suffering without air conditioning on the island of Manhattan.
Are you keeping slave labor, Tom?
It's outrageous.
All right.
It's really, really bad. When's the jobs report? I'm trying to get it.
It's the first week. It's the first week in July. We get the June jobs report. We get the on that Friday. I'll get the exact date out for you. I believe it's July 9th. Or maybe, I don't know. I'll check it in a second.
There it is, July 7th.
July 7th,
late,
excuse me.
Yeah,
right now, let's take a look at the markets and see what's going on. You are seeing a lift right now. A bit of a reprieve after yesterday's sell-off that was led by the tech names. You're seeing today a bit of a reprisal in the S&P, a little bit less of a gain, about 0.1%. Euro strength, to me, Tom, this is important.
Yeah.
Getting close to that 110 level, 109.47, after that really hawkish discussion from ECB's Christine Lagarde this morning.
I'm going to triangulate it right over to the new Bank of Japan governor at Centro with Francine Lacroix. And this is a fragility. It's been off our radar with Russia and with all that's going on within economics, finance, and investment. But you know what? Here's the theme. Euro stronger, yen weak. You don't have to know anything else. Yeah, yen 143.55. I'm not on the collapse watch, the YCC watch, but we're getting there rapidly.
Especially given the fact that the Japanese economy has been a haven for so many people who keep saying, let's buy Japanese securities. I'm also watching yields grinding higher at the front end around the world, and that yield curve getting that much more inverted, particularly over in Europe, Tom. That's interesting to me.
Oh, we'll have to see. I mean, there's no other way to look at it as well. Futures up 3 in the Dow and negative 51.
As we look forward, the question around the earnings surprise and whether this is going to be something that becomes a pattern is really the main theme I keep hearing from people. Joining us now to discuss, Cameron Dawson, I'm so pleased to say, Chief Investment Officer at New Edge Wealth. Cameron, how much is that on your radar, that earnings may be the catalyst to the downturn, to the caution that so many people have been warning about?
Yeah, I think it is the important factor because even though we still see a lot of dire economic forecasts, effectively economists have us starting a recession in just a few days in the third quarter, you don't see that in the earnings forecast. You see a big recovery in the back half of the year and then an even bigger recovery into 2024 and 2025, driven by resilient economy and big margin expansion. So that would be the key source of downside surprise if we don't see those earnings materialize. And we're watching the margins really closely because inflation has been actually very good for margins. It's why we think we got to record margins in 21 and early 2022. So as inflation continues to moderate, pricing power moderates, that could put downward pressure on those margins.
You've been cautious for quite a while. Are you getting more cautious or less cautious?
So we've been cautious in expressing it by remaining invested but staying in quality and saying that we don't want to be taking big risks on very cyclical, economic sensitive parts of the market at the same time as not wanting to take risks with things that are more speculative, that really require the boost that you get from central banks easing policy to see their stock prices do really well. What's interesting is that we have seen those stocks lead this year. And that's been one of our biggest surprises, is that you have seen the Fed continue to remain very hawkish. But at the same time, you've been seeing liquidity sensitive parts of the market lead the charge higher because there has been a huge divergence of yields and valuations.
At New Edge Wealth, how do you respond to people that say, I'm scared stiff, I don't want to participate in the equity market?
Have a long-term perspective and have a plan. Because at the end of the day, we have two things that we need to avoid as financial advisors. We need to keep people from selling at the bottom and buying at the top.
This used to drive Peter Lynch. He would lecture on the giant at Fidelity. He actually went in one day. He was so angry. They actually went into Magellan. This is folks in the heyday of Fidelity Magellan. And he ordered a survey of who bought at the top and at the bottom and sold at the bottom. And it was stunning. The percentages were just stunning on your observation.
And one of the things how we navigate this is by focusing on quality through cycles. Those companies that go down less than they went up in the prior up cycle. And what that leads us to do is not necessarily chase big, huge rallies like we've seen in certain pockets of the market this year and take kind of a tortoise versus the hare approach. We'll probably get to the same place at the end of the day.
Thank you. Thank you, Tom. I appreciate it. Carry on.
We'll probably get to the same place without having the big wild swings of volatility as you chase to the upside and then see big reversals to the downside.
So here's, I think, the existential question of the year. People are saying it's a recession delayed. not necessarily deterred completely. You're talking about some of the sectors that did really well this year, even in the face of the rate hikes. That will play out just later. When do you say the models are broken and that this is something new, something different at a time when this economy and these markets seem much more resilient to rate hikes than ever before?
That's the key point. And I think that this is a function of 10 plus years of quantitative easing that kept long interest rates down. It allowed people to term out their debt and effectively dulled the power of monetary policy going forward. Because one of the things that you've seen this year is that you're not seeing the impact from higher rates impact consumers or corporations simply because they were able to term out debt and have very long maturities. And so now, as you see rates rise, people kind of shrug simply because there is not that same impact.
Cameron Dawson with us here with New Edge. We will continue, but we do want to bring you the news as it comes from Russia. I believe that, well, we just lost the video moments ago. There was a very short video of a stark, larger room with 4 or 5, I'm going to call them Kremlin officials. I'm making it up, Lisa, as I go. And a lonely Mr. Putin at a podium. And the headline here from Bloomberg, we report Mr. Putin says Russia fully financed the Wagner Group. I don't know what else we're going to get about that. We have to get that in translation. But I would state moments ago a Putin sighting would be at least what we see.
And who is he speaking to? Some reports saying that he's speaking to military personnel, but it raises the mystery around what transpired over the weekend with the Wagner Group that is said to be disbanding today as Prigozhin, the head of it, heads over to Belarus.
And to Belarus, and that's one of the choice sets here. I believe it's a 3-pronged choice set. Join the Russian army, go over to Belarus, and I'm not even sure what the third choice set is. None of them are pleasant to see, I'm sure.
Cameron, I'd love your thoughts on this, because this is something we were talking about yesterday, that markets basically shrugged this off because it was a number of tail risks that you couldn't really price in. Do you have a renewed thought on that?
Our thinking is that unless there is something that keeps Russia from continuing to be able to flood markets with heavily discounted oil, that markets probably will look in the other direction. Because one of the key things that has been bullish for markets is the moderation in oil prices. Part of that is a function of Russia selling so much oil at discounted prices. So if we start to see something that could impact Russia's oil production or their ability to be able to continue to sell, that would be the key upward impact on inflation and thus downward impact on markets.
One more question. Where are you on a 60-40 reallocation here? It's mid-year. I got to reallocate. Do you believe in 60-40?
We believe in 60-40 plus alternatives because there are still fantastic opportunities outside of traditional asset classes where we see dislocations because of all the turmoil of the past couple of years, where we are starting to allocate to things like venture very selectively in private credit. It's a popular place to be, but we are finding great opportunities outside of your traditional assets.
Cameron Dawson, thank you so much. Greatly appreciate it. This morning. Red and green on the screen here. Futures up fractionally. I'm going to call it a modest lift with the NASDAQ, not like what we saw 2 hours ago, but nevertheless the NASDAQ up 0.3%. Lisa, the 10-year yield giving me nothing, 3.72%.
Just to give you some perspective on the NASDAQ, it might be up or indicated up right now 0.3%. Yesterday it was down 1.2%. It was a pretty significant sell-off after a couple days of weakness, and people were saying, is this going to be the beginning of something longer? Well, you know, maybe today is people saying this was the dip.
Fractionally, just a tea leaf off the Putin single headline that we saw on Wagner Group, a little bit of strength in dollar ruble as well. In the currency space, I'm going to call it a churn here. The euro 109.49. Standard & Poor's 500, let's call it flat.
Meanwhile, Tom, when you talk about Vladimir Putin, some of the other intel that we're getting, Vladimir Putin saying that Russia averted a civil war and that he basically said that he needed to act clearly and coherently in a difficult situation. Is he rationalizing what he did to an audience of people who are saying, are you creating two sets of standards where you're going to actually allow dissent after years of cracking down?
I'm not going there. I think the speculation is, you know, the good news is on a Tuesday morning in America, the speculation is less than the idiocy of Saturday evening. I mean, that's about all I can I give it. I think to speculate here, we just need to see observable FaceTime to see what Lukashenko says, obviously, and Putin. But where's this guy? His Wagner Group guy, like, surfaced?
there have been reports that the jet that he uses left for Belarus, left St. Petersburg for Belarus, either earlier this morning, late last night. Whether he was on it, we don't know. You talk about speculation, Tom. It felt like an imminent potential threat on Sunday, heading into Monday morning.
Oh, yeah, absolutely.
The fact that there's less speculation now is perhaps because people don't necessarily see the imminent threat, so they can forget about it and just not pretend to be experts on it.
Well, certainly that's what the market says. And again, watching oil maybe is the global litmus paper. It's a touch weaker, off $1.24 on West Texas Intermediate, 68.13. A breakdown there. It did print 66 for a cup of coffee 2-3 days ago. So it's not near recent lows. And again, I'm watching dollar yen 143 and euro yen a stunning 157 on strong euro weak yen as well. It is a most eventful day coming up. Economic data, lines of economic data. We need translation. Stephen Stanley, Santander. Good morning.
Putin facing the worst challenge of his career, and his best friend on the global stage, Xi Jinping, offered no military support, offered no direct defense. Putin really does not have real friends on the global stage. A lot of people want to buy his oil for cheap. A lot of people prepared to do business with him. Not a lot of people prepared to take any domestic risk to help him.
Ian Bremmer on fire yesterday. I said to someone last night at dinner, and I just said Dr. Bremmer was brutal on the brutality of the Wagner Group. I thought it was a breath of fresh air, Lisa Abramowicz, to have somebody with actual, legitimate international chops clear the air and say, this is what this guy's really like.
It's not as if he's the savior and is actually doing anything that is giving anyone any favors. This is someone who has been a war criminal. Question now is, what does this mean for Vladimir Putin? This morning we heard that he was saying that Russia financed the Wagner Group, which goes against what we had been reading earlier. Right. The Wagner Group financed themselves through some of their other activities.
We'll have to see. And thanks to our team working tirelessly through Saturday and Sunday to give you the show we had yesterday with In Perspective. Julie Norman with us from the University College London earlier today. It's just been really, really quite something. I have a confession to make. Somebody would say to me in international relations, where have you been most wrong? And I didn't get World War I wrong. I didn't even get Pearl Harbor wrong. But boy, with a vengeance, did I get October 4 of 1993 wrong. We are coming up on 30 years ago with the Boris Yeltsin Russian coup. And there were military tanks blowing up what's called the White House in Moscow with really military damage from shelling. And I got that completely wrong. Terry Haynes nailed it right now. He joins us with Pangea Policy on what we get wrong. Terry, what do we risk getting wrong with this uproar in Russia? I was so wrong on Yeltsin. What could I get wrong here on Putin?
Assuming that Putin is an extremist and about to topple, there are a lot of reasons for that. I think one is that what you've got is you've got Prigozhin essentially losing his nerve 100 odd miles outside of Moscow. You've got a situation where there's no obvious alternative to Putin. Thirdly, and I think most importantly, I think the West is not yet absorbing publicly anyway, just what a bad situation it is to have the Wagner people end up in Belarus, the same country that's got a bunch of tactical Russian nukes and borders not only the northern part of Ukraine, but the western, that has a western border with Poland and a north-south border with 2 of the 3 Baltic states. That strikes me as a bad cocktail. So, I don't think by any means done with this yet.
The bad cocktail, Lisa. Black October is one of the phrases the Russians used for 1993. 147 people killed, 437 wounded, and the 10-day conflict bordered on the worst thing in Russia, going back to Lenin. I mean, is this an equivalent? I'm not going to say that, but that's the study right now.
There was a lot of speculation and a lot of historical references over the weekend, Terry. At this point, we're talking now about what Belarus's role in this is. You mentioned that having the Wagner Group there, potentially having Prigozhin, the leader of it, in that nation, represents a risk to Ukraine and elsewhere. What are you looking for to understand what the dynamic of Belarus's role is?
Well, fundamentally, I'm looking for what Wagner is going to be doing and when and where they're going to be doing it. Back in the day, Churchill described Lenin's entry into St. Petersburg as a plague bacillus, and it strikes me that this might be another plague bacillus. If a destabilized Wagner in a supplicant Belarus is now free to try to figure out what pressure points it wants to hit, whether it be bordering on NATO countries or running down to Ukraine, that seems to be a new significant and potentially destabilizing threat. We've seen no evidence yet that that's going to happen, but Putin will use whatever he's got, as everybody knows, and so what he's proposing to get here is kind of a rogue paramilitary running around broadly doing his will. I think this is a worse situation for the West than is commonly understood right now.
Can you elaborate on that, especially given the latest headlines that Vladimir Putin is saying that Russia did fully finance the Wagner Group? Other people have pushed back and said the Wagner Group self-financed, particularly with its activities in Africa. What is Vladimir Putin likely getting at? Do you have more of a sense based on the rhetoric we've heard over the past couple of days?
Well, Putin will say what he'll say. I mean, and part of my admonition here from the top is that everybody, and no offense to the United States and Secretary Blinken, for example, for saying so, but everybody is saying things that are that are trying to put their thumb on the scale and do things that are and say things that might push their own self-interest. So that should be recognized, first of all. Second of all, to your point. What's happening here is, Wagner's been financing Putin as much as anything else or more. I'm sure Putin would like to keep that funding source coming in, not in Africa and elsewhere. So what they're trying to do is put a bigger handle on Wagner. Now, did Putin provide some seed money to get Wagner going all these years ago? Maybe, but I don't think that's relevant to the situation today.
Terry, off the Wall Street Journal work yesterday on intercontinental ballistic missiles, are we ready to have more American troops on the continent of Europe? Are we prepared to go back to our Ute?
I think we're going to have to, as part of a NATO force, continue to beef up to some extent, and that's one reason why I'm looking at Belarus and the borders with the Baltic states and with Poland. These are not only NATO allies, but these are areas where the United States and NATO troops already exist. Whether it be in Lithuania, Latvia, eastern Poland, protecting what's called the Suwałki Gap, which is the Polish-Lithuanian border that seals off Kaliningrad from the rest of Russia. And Putin may want to probe that. I don't know that I have no evidence to suggest that he will. But as I say, you've got a rogue force running around with nothing better to do. We should watch out.
Terry Haynes, thank you so much, with Pangea here on our international relations. I missed this last night, and Lisa picked up on it, but now we have a detailed printout from Morgan Stanley on the Zentner Amendment. Lisa, why don't you read the paragraph that Bloomberg News had last night from Morgan Stanley?
Yeah, Ellen Zentner of Morgan Stanley coming out. She had previously thought perhaps the Fed was done in terms of rate hikes. Now she says, we now judge that the bar for a July hike is significantly lower than we had initially expected and have added a 25 basis point hike to our policy path. We continue to see a soft landing, staving off rate cuts to next year. This is sort of the key distinction. She talked about about what changed for her, the lower bar for the Fed to raise rates, was the testimony that Jay Powell had last week in front of Congress. The fact that he said it made sense to continue to move rates higher, but at a slower pace. And that's something that we have heard from others as well.
The back end of the note is surprising to me, and this is the acuity that Zentner, Sarah Wolf, and the team do at Morgan Stanley, is they migrate. I mean, the math here is a little mysterious, but all you need to know is on a core basis, in core PCE, they break 4% soonish, like September, which, on a back-to-school basis could be tomorrow. 3.9% Q4 to Q4. We're not mentally prepared for that. I don't think, 3.9 is not 4.1.
Carl Weinberg was talking about this too, that disinflation will accelerate as the year goes on. And we were hearing this earlier as well, that the year-over-year comparisons make it easier to do so. If that happens, are we talking about a soft landing scenario that so many people wrote off as non-acceptable? I don't know. I mean, we've flipped and we flopped to such a degree. Coming up on The Open, we'll carry this conversation forward. Jordan Jackson of JP Morgan joining us, Tony Rodriguez of Nuveen, and Loria Calvasina of RBC, who has some really interesting things to say, in particular about sentiment and where that balance of risk
Where that balance is, and it's like one day the Calvasina world just moonshot, and the next day,
that's pretty much all of us right now.
To get an update on Lori into the end of the year for small caps as well. All in all, the tape deteriorates through the morning, but still NASDAQ up 0.3%. Stay with us. This is Bloomberg Surveillance. Bloomberg Surveillance on television, on radio, and at 8:29:41. On any given day, there can be one or two data points. Not today. I think there's 27. Only Mike McKee knows the math on that, but we've got to get out here on a Tuesday. Housing data. We're going to talk to Steve Stanley about this here in a moment. A brilliant note on your housing headaches in ownership and rental. But right now, with economic data flooding in, as they say, Michael McKee, head of all of our analysis here. What do we got, Mike?
Well, we've got durable goods orders coming in significantly stronger than anticipated, up 1.7%. The forecast was for a 0.9 fall in durable goods orders.
Ex-Boeing, wow.
It's probably Boeing, but ex-transportation is still strong, up 0.6, and that was expected to be flat. And, of course, the number that economists like Steve Stanley watch, the capital goods orders, non-defense, ex-air, also coming in stronger than expected, 0.7% compared to a 0.1 anticipation for that. And then shipments come in at 0.2. That's bang on what was the consensus of economists surveyed by Bloomberg. So right now I'm looking for the revisions. I'm wondering, Tom, there probably is a bit of a market reaction to this, given the fact that we've seen it come in stronger than anticipated, and that maybe helps with that idea of a soft landing. A
little bit of a yield response here. The 10-year yield 3.73%, a little bit higher yield there. Further curve inversion off the disinversion of the last 24 hours. If your head's spinning, stay with me. My head's spinning too, 97 basis points. There's a modest reaction. But, Mike, let's sell forward here to your work later this morning. This housing data is actually pretty important today, isn't it?
Well, it's interesting because new home sales are only about 15% of overall home sales, but there's no homes for sale on the existing side. I was down in Florida yesterday talking with a real estate agent about that, and there's just nothing available. So prices are rising on that side, offsetting some of the damage that's done by the Fed raising rates. But new home sales, there's a big backup in new home sales. We know that builders went into the apartment building business after the great financial crisis because nobody wanted to own homes at that point. And we're short on homes. There's big backlogs for the builders. So we see contributions so far from new home construction to the overall economy. And we'll continue to watch that to see what we get.
Right now, and we're going to stop here, and for all of you, frankly, worldwide, but certainly across America, Stephen Stanley is known to write very dense, acute notes. With Santander U.S. Capital Markets, he's outdone himself with a mid-year review of our housing market. I'm just going to start with one observation. Stephen, congratulations on this superb note of clarity. New home sales were 10, and now they're 14% of the market. New home sales are up 40% as the size of the market in this crazy pandemic we're in. It's completely unusual, right?
It is, and as Mike said, I mean, it's really. I think the genesis here is the backup in mortgage rates, right? Because if you own a home, you're sitting on a 3% mortgage, and all of a sudden mortgage rates are at 7%, your bar to moving is much higher. If you have to move, you move, but if you don't have to move, you stay.
When does that break? What is the catalyst that Santander sees out there that will change the odd housing market Mike McKee just saw in Florida?
Yeah, I think it's just going to take time for people to get used to higher rates. I think we're starting to see that a little bit in terms of the new home market. There was a period of time last year when people were just stepping back and saying, I'm not going to buy a home right now because mortgage rates are too high. And I think now people are realizing that maybe this is the new normal. So you still have this dynamic of people who are locked in with a low mortgage are less likely to move. And that is to the benefit of the builders. So it allows the builders to kind of rejigger their businesses, get their inventories in line, and you're starting to see a little bit of a pickup on the new home side, which is great because in the second half of last year, housing activity was falling at a 25% annualized clip. It was subtracting more than a full percentage point from GDP. Mm-hmm. All of a sudden in the first quarter, it was down 5%. So still negative, but only subtracting 0.2 from GDP. It makes a big difference.
The overall economy, and I'm going to look at this from the point of view of the durable goods orders we just got out now, has been sort of driven by consumers, and we've watched manufacturing pull back. But this is a relatively strong report. I've been going through it, and interestingly enough, a big drop in defense orders because that's a huge rise last month. Right. But overall, it doesn't seem to be much outside of cars and Boeing. What is the outlook for companies? If consumers are hanging in there, do they turn around and say, maybe we better refill our stockpiles?
So I think what we've seen in the last 3 to 6 months has been a bit of a breather on that front. Business investment in equipment was quite strong from the early days of the pandemic, much to the surprise of everyone. I think everybody thought there'd be a big adjustment there, and it turned out to be pretty brief. And then we saw strength throughout 2021 and into 2022. And the last few quarters have been softer. But as you mentioned earlier, we had a good number in April and now another good number in May for the core capital goods order. So it feels like maybe things are getting back on track. So my favorite manufacturing indicator is the ISM survey, and I think it gives a lot of color on what's going on. And that's been really interesting because what it's shown is that there's kind of a division of opinion amongst manufacturers, and it depends, of course, on what sector you're in. But about half of them felt like we were going to get weak first quarter activity because people were just adjusting inventories and getting back into line, and the other half was more worried about a more persistent decline. It feels like maybe the first camp, there was some validity to what the first camp was thinking if you're looking at these orders numbers coming back in the last couple of months.
Well, are you optimistic then about GDP for the rest of the year? A lot of people are still thinking we're going into recession in the third or fourth quarter.
Yeah, no, it feels like the consensus call on the economy for the last, 12 to 18 months has been we're going to get a recession next quarter. And the date just keeps getting pushed back further and further. And I noticed the latest Bloomberg monthly survey of economists, it got pushed back another quarter from Q3 to Q4.
It's worked out.
Yeah, but I've been all along, I've been of the view that the economy was going to prove more resilient, and it has, and I think it will continue to do so. But if you look at GDP, if you look at the components right now, it's an interesting mix because you do have areas of weakness. We talked about housing, we talked about business investment and equipment, but at the same time, not only is the consumer strong, you've got good government spending because state and local governments are still spending, their excess cash. Right. You've got a boom in construction and like manufacturing facilities. Part of it is the chips sector, but even more broadly than that. So there's a lot of cross currents right now.
If you and I were sitting in Davos on a panel, and Anna Boten was out in the audience, she'd raise her hand and say, "Mr. Stanley, you work for me. I have a question." And we would take Anna Boten's question.
Absolutely.
And she would say, "What is the technology overlay right now on the two Americas out there?" Mike McKee's been brilliant about this for 20 years. There's an America out there that's getting crushed. and there's an America that's technology driven, frankly, like a lot of the Spanish economy. I mean, it's technology to the fore, isn't it?
It is, and I think of course, the latest flavor is AI, and I think the concern there amongst a lot of people is that AI is now threatening jobs of people who before were on the right side of that divide, right? So, 10, 20 years ago, it was all about using technology to become more efficient in terms of like blue collar labor. And now all of a sudden the professionals are at risk. So that'll be interesting. I mean, I will say, just thinking very broadly, this argument has been around certainly as long as I've been doing this, that technology was going to steal jobs and there weren't going to be job opportunities. And they always, yes, they do take away jobs in some areas, but they always add jobs in other places. I mean, look, the unemployment rate's 3.5%. So the economy is evolving. Workers need to be dynamic and be able to, segue into different fields. But the economy always seems to create new opportunities.
Mike, where are we in September? We come out of Labor Day. We come out of Jackson Hole. We've got a Fed meeting. Ellen Zentner says she's changed her mind. They are going to lift rates here in July. How do you perceive this for, say, September 10th, just to pick a date?
I would argue that I have no idea. I mean,
thank you. That's the surveillance way.
Just doing the math alone, if the numbers continue like this, it would be very hard to get a recession mathematically. And Steve, I wonder then, everybody talks about the possibility of soft landing. How would you define it, and when would you declare it if you were the Fed chairman? I go back to the Vietnam War and Senator Aiken of Vermont, who said we should just declare victory and go home. Does Jay Powell get to declare victory and go home?
No, and this is the problem with this analogy, is that the economy never really lands, right? So, we talked, coming into the year, that was the first question everyone wanted to ask. Is it going to be a hard landing or a soft landing? And that presumes that we're playing a game with a specific end date, right? Is the economy in recession at June 30th or not? And if it's not, that's a soft landing. Well, the economy doesn't land, it keeps going. So if we continue to see growth, I would say, probably a little bit on the subpar side, but still well above zero. To me, that's not a landing at all, really. If the Fed has to keep tightening, eventually the economy is likely to crack, but we're not there yet.
Jonathan Miller Samuel, new high rents in Manhattan, and yet people like you are telling me we have rent disinflation. Update us on that.
So
nationally, we do. We're
about to get a new reading on home prices, and it's been interesting because just when it looked like home prices were going to fall, they've rebounded. And I think you're seeing a little bit of the same thing on the rent side, where what we were expecting was really more of a correction than a decline. It certainly wasn't a bust, but home prices and rents went up so much in the last 2 years that there was a presumption, well, they've got to come down somewhat. And they came down for a few months, and now all of a sudden it looks like they're rising again. So it's just a testament to how strong the economy is, how liquid households are, and it's a strong market.
Steve Stanley, thank you so much, with Santander, the chief U.S. economist, this morning. I got to sell forward here. What are you going to be doing at Case-Shiller 9 a.m.? Where are you in the Bloomberg world at 9 a.m.?
I will be with your co-anchor, Lisa Abramowicz, who's filling in for your co-anchor, John Ferro. That sounds a bit like Russia. Russia invading Russia to free Russia from
There's not
Lisa filling in for John.
We have not had a Ferro sighting yet. He's on one of the unpronounceable islands over in Italy on a well-deserved assignment as well. What we've got is a nice lift to the market. Standard & Poor's 500 up 0.2%. And we say good morning here, Michael McKee and Tom Keene. Lisa Abramowicz, as Mike says, getting ready for the 9 o'clock hour. Ferro's, I mispronounced it. I butchered it. I said Ischia. And oh my word, thank you to our global audience for straightening out the ugly of marrying. Ischia, I think is how you've been there, no doubt. Yeah, I need to get a life. Mike, I want to talk about what we saw in adjustments today from Ellen Zentner at Morgan Stanley. Do you anticipate lots of mid-year adjustments by economists as they get out front of the July and then the September meeting?
Well, I think the adjustments may come more slowly. There are people who just want to jump on a bandwagon. But if you're watching the data, it's going to be about do the inflation numbers and the jobs numbers come in as the Fed expects? And I think the jobs numbers could be a real key.
July 7th.
If we get a big
late.
increase in unemployment like we did
Yeah.
last month, then that raises questions about whether they need to tighten more or not. They seem to want to, so I would bet that they will. But at this point, they're still somewhat data dependent. And so when you're making a call, you're suggesting the numbers will come in as the Fed expects.
I have a sentimental bias at 9 a.m. here, folks, in 20 minutes to the work of Robert Shiller of Yale University and someone truly iconic in American economics, Carl Case at Wellesley, in what they did with the Case-Shiller Index, the S&P CoreLogic. It's the Case-Shiller Index. Mike, it's an important data point today of flatness, isn't it?
Well, it'll be something that economists are watching because they want to see where home prices are going and how that's going to affect those inflation numbers we care about. We also get new home sales at 10, and that has a price component to it as well.
And the economist Bramo says she's riveted to the Dallas Fed Services Activity Index. I'm not. This is Bloomberg. Good morning.
I think it's going to be probably a softer landing in that camp. And the Fed, in its statement, while it did not increase rates, was relatively hawkish because they added the potential of having one more 50 basis point increase later this year. But the markets have not quite bought into that.
The right person at the right time. That must mean it's a conversation with David Rubenstein. Afsana Beschloss is one of my favorite people in the world. She is prodigious in knowledge of international hydrocarbons. This is exceptionally well timed. From Rock Creek, Afsana Beschloss with David Rubenstein. Look for that tonight at 9 p.m. An important conversation, and in hindsight, even more important given the uproar that we see in Russia, Belarus, and Ukraine. He is with the Carlyle Group. David Rubenstein joins us this morning. David, I literally got goosebumps. She is just the perfect person to talk to. Tell us what Ms. Beschloss brings to the table.
For those who don't know, Afsana Beschloss is an immigrant from Iran. She was educated at Oxford. She was the Treasurer and Chief Investment Officer of the World Bank and subsequently started her own firm called Rock Creek, which is now probably the largest woman-owned investment firm in the United States, certainly the largest woman-owned firm by a woman who's an immigrant, managing about $17 billion. Afsana is involved in a lot of philanthropic activities as well, on the board of the Council on Foreign Relations, Rockefeller Foundation, chairman of the PBS board, and so forth, PBS Foundation board. And she's really very insightful about where the economy is going because she's investing this $17 billion on a daily basis. She's really actively involved in the markets. And she has a very good knowledge as well about the energy world because that was what she first studied when she was at Oxford.
I'll say she's really quite good at it in conversation after conversation over the years. David Rubenstein, just in the last 24 hours, we've seen Lawrence Fink, I believe over in China with the World Economic Forum, not backtracking, but finessing the new ESG message. To me, Dr. Beschloss is hugely focused on the realities of hydrocarbon. What were her thoughts on climate change and on this recalibration of ESG?
Well, her view is that the energy transition is underway. Obviously, it's not going to be happening overnight. On ESG, she's been a big believer in ESG and is very focused on it. Clearly, there's pushback now, but in the end, I think it's trying to, put your finger in a dike, trying to stop ESG from coming forward. Many people around the world are not as worried about the politics of ESG as many people in the United States might be. And as a result, you're seeing in Europe and other parts of the world a real concern about ESG and the need to be more sensitive to environmental concerns. And Afsana reflects that because she's really a global citizen in many ways. She's lived in many different places and invests all over the world.
She's in Washington, as are you. It's a cutthroat job environment. What is the distinction of Rock Creek and their shop as they try to keep, find, and retain outstanding women employees and managers?
The firm has about 50% of its investment professionals and employees are women. There aren't that many investment firms with that higher percentage of that size. It's a very large firm at this point, managing, as I mentioned, $17 billion. So it's been a bit of a struggle, I would say, to be an immigrant and to be a woman trying to build a firm like that. I've known her for a while, and briefly she worked at Carlyle, I should say, and before she started her own independent firm. And I would say that she's known to many people around the world for being very smart, very articulate, and very conscious about the importance of ESG. I should also note, for those people that recognize the last name, her husband is Michael Beschloss, who's the distinguished presidential historian.
Oh, he's not only a distinguished presidential historian, but David, let's be clear, her husband has kept Twitter sane here in all the uproar. He's a national institution with informing the public of presidential history out on at Twitter. I look, David, at where we are right now, and I want to speak to you with your public service to the nation and the Carter administration, but almost a nation starving off the recent NBC poll for some form of middle ground or moderate politics from both parties. How do you perceive that the moderate voice, maybe what Agnew would call the silent America, how do they find their voice in this crazy presidential campaign to come, both Republican and Democrat?
Well, that's a very fair and very difficult question to answer. Politicians typically raise their money from the far left and the far right. It's very difficult to raise money saying, I'm going to be right down the middle. I'm going to balance the left and the right. I'm going to come up with a good compromise that everybody should be pleased with. That doesn't raise a lot of money. And as we know in politics, money is very important. People are spending all their time raising money in Washington, D.C. So the moderate voice is very difficult to prevail. Hopefully, we'll have more moderate voices. Last night, for example, I interviewed somebody that some may not say is moderate, but at the 92nd Street Y in New York, I interviewed Liz Cheney. Now, clearly, people on the right side of the spectrum would say she's not moderate. People on the left side would say, well, she was very conservative. Now she's doing good public service kinds of things. But whatever you think of Liz Cheney, finding people down the middle that people on the left and the right can agree on is very, very difficult. And I would say it's the biggest challenge that we have in our presidential campaign is how do you get your head above water, get some attention, unless you get something done on the far right or the far left, which gets the attention. Coming down the middle doesn't get much attention.
Well, Ronald, I'm going to suggest, and I defer to you, David, but Ronald Reagan codified this process. There's just no question Ronald Reagan was the one, literally as an FDR Democrat in his childhood, came over the Republicans, grabbed the right, and moved to the center. Is that process dead?
Well, Ronald Reagan was seen as being on the far right, more on the right than his competitor at the time, Gerald Ford. But ultimately, the far right became the center. And so today, Ronald Reagan would not be seen on the far right. Donald Trump might be seen on the far right, but not Ronald Reagan. But Reagan is somebody who, had a way to communicate that was great compared to other politicians. He was called the great communicator for a good reason. And even though I was not his political supporter, I like to quote him from time to time. And my favorite Ronald Reagan quote is, the most dangerous words in the English language are, I'm from the federal government, I'm here to help you.
Well, I think that there's a little bit of that going on based on the zeitgeist right now. David, let us bring it back to hydrocarbon here and Dr. Beschloss. What's her view on a barrel of oil out 1 year or a Rock Creek 3 years?
Well, as a general rule, if you ask the CEO of an energy company where oil prices are going to be in a month or a year, they will laugh because nobody can really know. At the moment, given the uncertainties in Russia, I suspect oil will drift up for a while. And as the Saudis seem to be trying to cut down production a bit, I suspect there'll be a further drift up. But again, I don't see $100 oil anytime in the near future. But I do think you'll probably see it drift up from the high 60s to the low 70s in the not too distant future.
David, thank you so much for the generous time today. David Rumstein of the Carlyle Group at Far More with these conversations for Bloomberg. You can see them, of course, on Bloomberg Television tonight. Afsana Beschloss of Rock Creek here on Bloomberg Wealth, but also on our wonderful digital platform. And in YouTube, we're really sprucing that up. I'm really happy with the headway we're making out on YouTube to get these interviews and the conversation out as well. It's been an extraordinary day. I'm going to dovetail it, as Lisa Abramowicz said, with the Zentner call on a rate rise, I should say, at the July meeting, and over to all that we've seen from Russia in some of the little drabs. For example, the Putin speech this morning, I'm going to say it was 6 minutes, plus or minus 2 or 3 minutes. There are these little small windows that someone like Maria Tadeo has to try to interpret where are we on a Tuesday afternoon. I'm going to call it 4 p.m. in Moscow and over to Belarus and Ukraine as well. We'll have to see how that plays out into the evening as best we can. What you need to know, economic data coming up. We like the data that we saw here at 8:30 with Michael McKee. NASDAQ 100 up 0.4%, SPX up, Dow slightly red. The yields are just a mess. There's no other way to put it. Curve inversion's improved, less inverted over the last 24 hours. I'm going to call that 95 basis points on the 210 spread. But coming up, as we heard from Stephen Stanley, critical housing data. Stephen Stanley's note from Santander, please get that from the bank. We protect the copyright of our guests. But boy, I'll tell you, it is a tour de force on the housing economics, ownership, and rent that we have right now. And the summary for Stephen Stanley is there just seems to be a brighter horizon out there for housing. Can you imagine that with a mortgage rate of 7.25 or 7.50? I can't get my head around that. Stephen Stanley of Santander on the housing market, just brilliant to say the least. On the dollar, slight dollar weakness this morning. And for David Rubenstein, West Texas 68.58. Good morning.